Good evening, guys. Good evening, everyone. Please confirm if the audio and video is clear to everyone. Please confirm the audio and video is clear to everyone. Okay. First of all, tell me, did you revise the day one, all chapters which we discussed? Did you revise all the chapters that we discussed as part of day one of the revision series? And solve the important questions also? Good evening, Vishali. Good evening, Monica, Vishali, Riddhi, Harsh, Krish, Dakshesh. Good evening, everyone. Okay, wonderful, wonderful. I believe there are no further queries. In that. Okay. And now, today we are starting the day two of the. Yes, I know it was tricky. Now, yes, tell me, which option will you select? Solving the tricky questions now and making it easy for the exam, or solving the tricky question directly in the exam, right? So the option is with you guys. Okay, you have a doubt, you can WhatsApp me. Definitely we can discuss on that. Okay. Now, so let's start with the day two of the revision series without wasting any further time. Okay. Now, but first of all, why this? I can see only the likes. There is a disparity between the viewers and the likes. Come on, guys, please like the video. All of you. Okay. Now, so let's start it. So today we'll be discussing three chapters, particularly leases, financial instruments, and revenue. Okay, leases, financial instruments, and revenue. This is the day two of the ACCA financial reporting revision session. Okay, let's discuss it off. So, first of all, we start with the leases. Now, under leases, understand what exactly is the meaning of lease. What exactly is the meaning of a lease contract? Okay. How is the Josh? Very high. Okay, now what exactly is the meaning of lease? So now, if you can recall, we always used to discuss that the lease has 5 components. What is the 5 component? The lease is first of all, it is a contract. Okay, now contract for what? I have to take the right to use of an asset. Now, am I taking the ownership? No, I am taking just the right to use. Okay, let's suppose if you have taken a property on rent, what do you get? You get the right to use that property. You don't get the right to ownership. Okay, now, so under a lease contract, it is a contract which gives the right to use of what? Of an identified asset for the entire life? No, for the specified period of time. Now, is it for free? No, in exchange of consideration, which is also called as lease payments. Right? Is that clear, everyone? Still I can see the disparity, guys. Come on, guys, please like now. So this is the meaning of a lease contract. Now, and you have to continue to give me boosters. Okay, you have to continue to give me boosters. Now, for the lease date, now understand that under a lease contract, there definitely you will see there are two important dates. Okay, now the two important dates are, first one is lease inception date and the second one is the lease commencement date. What is the meaning and the relevance of these dates? So the meaning of lease inception date is the date on which the contract has been entered into between the lessee and the lessor. Now you will ask me, sir, who is lessee, who is lessor? What is the meaning of lessee and lessor? So under a lease contract, there are two parties. See, this is party number 1 and this is party number 2. Okay, now this is hers and this is let's suppose Chris. Okay, now Chris has given an asset to Hers for using. So since the Chris provides the right to use, Chris will be called as lessor, and Hers has obtained the right to use, Hers will be called as lessee. The person who obtains the right to use is called as lessee, and the person who provides the right to use is called as lessor. Okay. Now, on the inception date, just the terms and conditions of the contract is finalized or the contract is signed. Okay. But the lease commencement date is the date when the asset is made available to the, tell me what, to whom? Asset is made available to whom? Asset is made available to whom? Lessee. Asset is made available to whom? Lessee. Okay. Now, so this is the meaning of the lease inception date and the lease commencement date. Now we have to understand what is the relevance of these dates. Understand. Just Chris and Hers. Okay. Let's suppose this is how the understanding goes. Okay. Chris and Hers. Okay. So Hers called Chris. And Hers is telling Chris bhai, I need a property on rental. Chris bhai, I need a property on rental, please give me. Okay. So now Chris is asking here. Okay. Okay Hers, tell me what is the area you are looking for. So Chris is telling, I need 2 BHK. I need a 2 BHK flat to stay. Now, okay, fine. So this is the rental I am looking. They discussed all the terms and conditions. Now Hers is telling, shall we sign a contract? Now they both agreed on the terms and they signed the contract. Okay, they signed the contract. Now again Chris is asking, Chris is the lessor, when do you need the property? Hers, when do you need the property? Now Hers is saying, I need the property after 4 months. So now understand. Just they have signed the contract for now. Has the lessor, tell me, lessor has given the asset to lessee? No. Is the lessee obliged to pay any amount to lessor? No. So any monetary transaction has happened? No. Right. So will we record anything in the books of account? No. Right. So what we have to understand here is on the lease inception date, only the contract is signed. And on the lease commencement date, the asset is made available to the lessee. And since the asset is made available to the lessee on this date, and this is because this is the date when the lessee and the lessor starts accounting for the lease. Why? Because it is from this date the accrual concept starts. Right. Now, on the lease inception date, what is required to be done? We are just required to assess this contract and conclude whether this contract is a lease contract or not. That's all we have to do. Okay. So now what is the importance and the meaning of these two dates? Is it clear, everyone? Tell me, guys, come on. Is it clear, everyone? Tell me. Wonderful. Now, the accounting treatment. I will give for every day, Yash. I'll give it every day. Okay. Day 1 done, day 2 done, day 3 I will announce at the end of the day 2. Okay. I will announce when I will take the day 3 at the end of the session. Okay. Now, lease accounting in the books of lessee. So first of all understand here, as I told that under a lease contract, there are two parties, lessee and lessor. Okay, lessee and lessor. Karan has a query, sir. When we impaired the asset and sale on the same year, the asset was revalued. Karan, your query is from day 1. Okay, if you want me to discuss this query, please ask me at the end of this session. Okay, taking it in between will just you can say impact the flow of the class. Okay, or you can discuss with me over the WhatsApp. You can just ping me. I'll definitely respond it to you. Okay, just ping it your query to me. Now, lessee and the lessor. Now, lessee and lessor. Now, what happened? Lessee accounting and lessor accounting both is there in IFRS 16. Okay, lease accounting is covered as part of IFRS 16 is covered as part of IFRS 16. Lease accounting is covered as part of IFRS 16, and IFRS 16 says that there is a lessee and there is a lessor. Okay, now lesser accounting is not in our syllabus, of financial reporting. You will study the lesser accounting at SBR level but not at FR level. Okay, so we will not discuss the lesser accounting part. Now let's come to the lessee accounting part. Now understand. Tell me one thing. When you purchase the asset by paying cash, tell me what is the journal entry that we pass? Asset account debit to bank, right? Now when we purchase an asset by on credit, what is the journal entry that we pass? Asset account debit to creditors. Okay. Now when we purchase an asset on EMI model, okay, basically we have got the asset right now, but we will be paying the consideration for purchasing that asset over a period of time. Every year a fixed amount of money I will be paying. Okay, every year or every month I will paying a fixed amount for 2 years or 3 years. Now what is the entry for that? So it will be asset account debit to liability, and we will record the asset and the liability by the present value of the future payments, Now in the lease, when we are talking about a lease contract, now standard is saying that when you are taking an asset on lease, okay, what the difference between purchase and lease, understand the difference between purchase and lease. So when you purchase the asset, okay, you get the ownership of the asset, but when you take the asset on lease, you get the right to use the asset. Ownership is not there, right? So standard says that since you are getting the right to use, you have to record the right to use asset. Meaning thereby when you purchase an asset, you get the right to use, you get the ownership both. But when you take the asset on lease, you get only right to use but not the ownership. So standard is saying you have to record the asset to the extent of right to use. You have to record this asset to the extent of the right to use. Okay, now so this is what it is. This is what is the lease accounting. So come here. So initially what we will record, lease accounting in the books of lessee, initially we will record right of use asset account debit to lease liability. Why lease liability? Because this liability is arising under lease contract and hence it is called as lease liability. Okay, this is how we will recognize the lease accounts. Okay, lease transaction. Now comes the question, how to measure a lease liability and how to measure a right of use asset. Okay, now let us understand that. Now, so standard says that the lease liability you will measure at the present value of the future lease payments over the lease term. Okay, whatever payments the lessee is making to the lessor, you have to calculate the present value of it. On the lease commencement date, calculate what is the present value and recognize that as a lease liability. Is that clear, everyone? Now comes two questions here. You should ask me, sir, what is the meaning of future lease payments and what is the meaning of present value? Okay, how to calculate the present value? Basically, to calculate the present value, you will need the discount rate. Okay. Now, so what discount rate shall I consider? You should have two questions. What is the meaning of future lease payments and what is the discount rate that I should consider while discounting the future lease payments to arrive at the lease liability? Now, yes, as a query sorter of lease term or life, I am not discussing that part as of now. Yes, I'll come to that part, but not now. Okay. Giving SBR in September, should I watch this lecture? you can it will help you, but not fully, okay, because in SBR there are other topics also, like modifications and remeasurements, okay, and lesser accounting and sublease and all concepts are there, so which is not there in FR at FR level. So to the extent it is there, you can watch, it will be of help for you, but for there are something additional at SBR level, okay. Now comes the meaning of what exactly is the meaning of future lease payments. Now understand, the lease payments can be structured in any possible manner, okay. So the lease payments can be fixed, can be variable. Now under fixed lease payments also, it can be pure fixed, let me explain it to you. The future lease payments can be fixed, can be variable, okay. Now fixed can be pure fixed, and fixed can be semi fixed, okay, and variable. Now understand one thing. Let me tell you, this is the lease commencement date. The lease term, let's suppose, is 1 2 3 4 5 years. The lease term is 5 years. Now tell me, you have to calculate the present value on what date? Tell me, you have to calculate the present value of the future lease payments on what date? First of all, my first question, you have to calculate the present value of the future lease payments on what date? Lease commencement date. Very good. So I will have to calculate the present value here. Right? Tell me yes or no. Now. But now tell me, if you have to calculate the present value here, now tell me, let's suppose these lease payments are variable. The lease payments are variable. Can you calculate the present value? If the lease payments are variable, can you calculate the present value? Tell me. If the lease payments are variable, can you calculate the present value? No, you cannot. Vaishali, it will not be lease inception date, it will be lease commencement date. I told it earlier also, lease inception date is just for the assessment whether this contract is a lease contract or not. The accounting will start on lease commencement date, okay. Now, so if the lease payments are variable, we will not be able to calculate the present value. Why? Because if it is variable, standing as on this date, we will not know what will be the amount of lease payment that we will pay here. We will not know. Okay. Let me give you an example. Let's suppose the lease payments are 100,000 per month. Sorry, 100,000 per annum. 100,000 per annum. 100,000 per annum. Can you calculate the present value? Tell me. Can you calculate the present value? Yes, you can say yes. These lease payments are fixed and we can calculate the present value of it. But now let me give you another example. Let's suppose these lease payments are 3% of revenue of the entity. 3% of the revenue of the entity. Same. 3% of the revenue. Tell me, will the lessee know what will be my revenue for this year? What will be the revenue for this year? Standing as on this date, standing as on this rate, standing as on the lease commencement date, will lessee know what will be my future revenue? No, the lessee will not know. Right? So in that case, can we calculate the lease liability? No, we cannot. So the only point which I'm trying to say here is the lease payments which the lessee knows or which the lessee can calculate standing on the lease commencement date are the lease payments which will be considered in calculating the lease liability. Let me write it here. The lease payments which lessee can compute standing on lease commencement date, okay, will be considered in calculating lease liability. What about other lease payments? What about other lease payments? They will be recognized in P&L as rent expense. They will be recognized in P&L as rent expense. Is that clear to all of you? Tell me. Is that clear to all of you? Tell me, guys. Come on. Is that clear to all of you? The meaning of lease payments? I have given here example also. See, pure fixed means what? $100,000 per annum. Okay, so it is fixed. It will be considered in calculating the lease liability, right? Now, in substance, fixed means what? $100,000 per annum or 3% of the cash flow from the asset, whichever is higher. Now, understand in this example what happens. Let's suppose 3% of the cash flow comes to 90,000. Tell me how much we'll pay? 100,000, because it says 100,000 or 3%, whichever is higher. So if the 3% of the cash flow comes to 90,000, I will pay 100,000. If the 3% of the cash flow comes to 95,000, still I will pay 100,000. If the 3% of cash flow comes to 110,000, still then I will pay 110,000, right? But in all the three scenario, 100,000 was common. 100,000 was common. 100,000 was common, right? So what I will write here, 100,000 will be considered in calculating lease liability. Any extra paid in any year will be recognized as this treatment. It will be recognized in P&L as rent expense. It will be recognized in P&L as rent expense. Is that clear? Now, if it is pure variable, that is 3% of the cash flow from in the asset, okay, not considered in calculating the lease liability. What is the treatment? The treatment will be this one. Recognize that in the P&L as rent expense. Okay. Now, if you have a residual value that is guaranteed, it is also considered in calculating lease liability. The guaranteed residual value with what is the meaning of guaranteed residual value? The portion of residual value guaranteed by lessee to the lessor. Guaranteed by lessee to the lessor. Okay, that will also be calculated and considered. This will also be considered in calculating the lease liability, right? Unguaranteed part, no, we will not consider, because these are not the lease payments which the lessee pays to the lessor. No, lessee is not paying anything, right? Lessee is not paying, so this will not be considered in calculating the lease liability. Is it clear, everyone? Tell me. Is the meaning of lease payments clear to everyone? Is the meaning of lease payments clear to everyone? Is the meaning of lease payments clear to everyone? Come on, guys, tell me. So meaning thereby, if anything is fixed, always think like this. If the amount of lease payment is fixed, we will consider that in calculating the lease liability. If it is variable, we will transfer it to P&L as rent expense. If it is variable, we will transfer it to P&L as rent expense. Is that clear, everyone? Tell me now. Wonderful. See, that's what I am writing here also. Any lease payment that is not considered in calculating lease liability is recognized as rent expense in P&L. Is recognized in P&L as rent expense. Is that clear, everyone? Now tell me. So this is how we will measure the lease liability. Now comes the second question, that is, what is the meaning of discount rate? So discount rate, the standard suggests us, the standard says that we will take interest rate implicit in the lease. But if at all interest rate implicit in the lease is not available, then you will take incremental borrowing rate of the lessee. Let me ask you a question here. Let me see who all are understanding it properly. Let's suppose in the question, you have been given incremental borrowing rate and the implicit rate both. Tell me which rate will you take for discounting? Which rate will you take? If the question gives you both rates, which rate will you take? Implicit interest rate. Very good. Okay, but if the question is giving you either of the rates, let's suppose the question, there can be three possible situations. The question is giving you only incremental borrowing rate. Well and good, you take incremental borrowing rate. If the question is giving you implicit interest rate, okay, fine, take implicit interest rate. If the question is giving you both the rates, then also take implicit interest rate. Okay, this is what I'm trying to say here. Okay, now you know what is the meaning of future lease payments. You know the discount rate. Can you calculate the present value? Can you calculate the present value of this? Tell me, can you calculate the present value of it? Now, once you calculate the present value, it is called as this present value is called as lease liability. This present value is called as lease liability. Now, the examining team is saying that in the exam, I will calculate this present value and give it to you. I will calculate this present value and give it to you. Okay, the examining team is saying that I will calculate and give it to you the present value. Okay, then sir, why are you teaching all this? If the examining team will calculate and give it to me, then why are you teaching? For two reasons. Even if the examining team calculates and give it to you, let's suppose the question has a component of variable lease payments. You should know that the variable lease payment will be transferred to P&L as rent expense. Point number one. If the question asks you to calculate finance cost on the lease liability, right, and the question is giving you both the discount rate, right, so for that you should know that okay, I have to take implicit interest rate, because this present value would have been calculated considering the interest rate implicit in the lease and not the incremental borrowing rate. Okay, so for these two reasons I am explaining you this calculation. Tell me, is it clear to you till here? Come on guys, tell me. Awaiting your responses. So what I tried to say here is, I will write it off also. I don't want you to make a mistake in this part. Okay, examining team is saying mentions that present value of future lease payments will be given in question. Then why I discussed with you? For two reasons. Why I discussed with you this calculation of lease liability and the discount rate? Why? For two reasons. Why? To explain you that variable lease payments do not form part of calculation of present value of future lease payments. Rather they are expensed off to P&L. They are required to be expensed off to P&L as rent expense on actual basis in the year in which they are paid. Second part is, if the question provides you with present value plus incremental borrowing rate of lesser and both the discount rate and plus both the discount rate, and asks to calculate finance cost, then you should know that finance costs you will calculate on the implicit rate if both the rates are given. Okay, is that clear everyone? Just have a plain read of what I have written here. Just do a plain read of what I have written here and tell me, is it clear everyone? Confirm, guys. Is it clear, everyone? Is it clear? Wonderful. Now let us proceed further. Let us proceed further. Okay, right of use asset. Now tell me, a right of use asset. This is governed. This right of use asset is governed as per the principles of IAS 16, 38, and 40. Now tell me, under IAS 16 and IAS 16, 38, and 40, yesterday that we discussed in day one, how initially at what value do I recognize? Tell me. Initially, at what value do I recognize property, plant and equipment, or investment property, or intangible asset? At what value? Tell me. On initial measurement, at what price do I recognize the asset? At what price do I recognize asset initially? Tell me, initially. Cost. Very good, very good. Right. So here also cost. Here also cost. So it says that initially right of use asset you will recognize at its cost. Now cost means what? Cost means what? Amount which you have already paid plus the amount which you are required to pay in the future, right? Cost means what? Cost means what? The amount which you have already paid to acquire the asset plus the amount which you will pay in the future, right? Now that's what I have written here. See, right of use asset will initially be measured at its cost, right? Cost means what? Cost means what? Cost means what? Cost means amount already paid plus amount to be paid plus amount to be paid. This is the meaning of cost. This is the meaning of cost. Now tell me, under IAS 16, 13, and 40, I discussed with you something called as trade discounts or rebates. Tell me, did I discuss with you trade discount and rebate? That we have to reduce the trade discounts and rebates if I have got from the seller, right? If I received any discount, I have to reduce from the cost, right? Similarly, I have to reduce from the cost if I have received any incentives. I have to reduce from the cost if I have received any incentives from the lessor. Incentives from the lessor. If the lessor has given me any incentives, I have to reduce that. I have to adjust that from the cost, right? Now, what is the meaning of amount already paid? What is the meaning of amount already paid? It means upfront lease payments. Upfront lease payments. What is the meaning of upfront lease payments? Understand, guys. The lease payments can be structured in two ways. The lease payments can be structured in two ways. It can be paid in arrears or it can be paid in advance, right? What is the meaning of arrears and advance? It means that if you pay the, let's suppose you have taken a flat on rent. Okay, you have taken a flat on rent. Okay, now you have taken the flat on rent on 1st of April. 1st of April. If you are paying the rental for the month of April on 30th April, for the month of April, if you are paying the rental on 30th April, it is called in arrears. If you are paying the rental for April on 1st of April, it is called in advance. It is called in advance. It is called as advance. Okay. Now let's suppose on 1st April 2023, your lease contract commenced. Okay. Now for the entire year of 2023, you paid the lease payments on the very same day. On the very same day, you paid the lease payments. Okay. Now, so what is happened? It is called as what? Amount already paid. It is called as upfront lease payments. It is called as upfront lease payments. Okay, amounts paid on or before the lease commencement date. Amount paid on lease commencement date or before lease commencement date. Okay, now right here it also includes right here it also includes any initial deposits paid. Any initial deposits paid. If you have paid any initial deposits, it is also included here. Okay, if you have paid any deposit, it is also included as part of the ROU asset. Though when I will go to SBR level, okay, I will say that this whole amount of this deposit is not for ROU. A portion of it is a financial asset. I will discuss that. Okay. Yes, there are only two scenarios, advance and arrears. There are only two scenarios, advance and arrears. Okay. Now, further, it says that now tell me, when capitalizing a property, plant and equipment, and equipment, okay, then in that case, what happens? Is, you remember we discussed that any directly attributable cost incurred to bring the asset in the location and the condition intended by the management. Tell me, do you remember this? Do you remember this? As part of PPE, investment property and intangible assets, we discussed this, right? Any directly attributable cost incurred to bring the asset in the location or condition intended by the management will also be capitalized to the cost of the asset, right? Similar thing here also it says, if you have incurred any initial direct cost, it will also be capitalized to the ROU asset, okay? ROU asset. Now, yes, and few students are asking mid-year payments. See, understand, practically if you go, the payments can be made in the mid of the year, 10th of the following month, okay? It can be monthly also, right? It can be anything. Practically it can be anything, but as part of our syllabus, we have to study only the advance payments and the arrear payment, okay? This is what we have to study as part of our syllabus. Is that clear, everyone? Okay, in practical life there can be any given scenario. If let's suppose if Chris and Hers, they are negotiating, they can discuss anything, they can agree on a point, okay, as per their mutual agreement. It depends upon their mutual agreement, okay? So it can be anything, but in our syllabus we have to study advance and arrears only, okay? Now what about the, just strike it off, it is again for SBR level, not discussed. Okay, now what is the meaning of amount to be paid? Amount to be paid means what? Lease liability. Amount to be paid was lease liability, right? This is what I have not paid, I will pay in the future. So the present value of the future lease payments I will consider, right? So now what is the meaning of right of use asset? What is the meaning of right of use asset? So the right of use asset means amount already paid on or before lease commencement date plus initial deposits plus lease liability plus any initial direct costs. This is equals to your ROU asset. Is that clear, everyone? Tell me now. Is that clear, everyone, guys? Come on, tell me. Is that clear, everyone? Now it says initial direct cost, the meaning incremental cost of obtaining a lease that would not have been incurred if the lease had not been obtained. Means if it is incurred, like for example, I will give you two examples, okay? You have to tell me it is the initial direct cost or not. Example number one, okay? Now is a brokerage. Brokerage means what? I have to pay an amount to the broker if I finalize any property. If I finalize any property, I have to pay some specified amount of money to the broker, okay? So this will be incurred if and only if I take the property on lease, okay? So it is called as incremental borrowing cost, not incremental borrowing cost, incremental cost of obtaining a lease, or you can say the initial direct costs. So brokerage can be initial direct cost. Now let's suppose, okay, I paid an amount. Let's suppose I paid an amount to a legal consultant. Okay, I paid an amount to a legal consultant to review the property, to review the property. Now tell me, as an outcome of the review, if I don't take the property on lease, or if I take the property on lease, is it the case that I will not pay the amount to the legal consultant? Tell me. Is it the case that I will not pay the amount to legal consultant? No, I have to pay irrespective of whether I take this property or I don't take this property. I have to pay the amount to him, right? So this amount will be incurred irrespective of the fact whether I take the property on lease or I don't take the property on lease. So will this be forming part of initial direct cost? No, right? Brokerage will be paid only if I take the property on lease. So this will be forming part of initial direct costs. Is that clear, everyone? Wonderful. So what is general entry initial recognition? Right of use asset account debit to lease liability and to bank. Bank can have upfront lease payments plus initial direct costs minus lease incentives. Lease incentives are already registered as part of lease liability. So that's all. That's all. Plus you can say deposits. Plus you can say deposits if you have paid any deposits. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me. So this is how I will initially recognize a lease liability and a right of use asset. This is how I will recognize a lease liability and a right of use asset initially. Tell me, is it clear, everyone? On lease commencement date, this is how I will recognize the lease liability and right of use asset. Is it clear, everyone? Definitely, don't worry at all. What I'll do after discussing the subsequent treatment, I will take up an example with you, okay, covering each and every point, whatever I have discussed, and I will make it clear to you guys, okay, don't worry. Now, subsequent treatment. Subsequently, what will happen? This lease liability is like a financial liability, and it will discussed as, it will be considered as per IFRS 9, financial liability. So now what will you do? What will you do for this financial liability, for this lease liability? So you will record finance cost on this liability and you will pay this liability, okay. Now, what about this right of use asset? So you will depreciate in accordance with IAS 16 or 40 over the lease term. This again you can remove. This again you can remove. Okay. Now, so you will have to depreciate it over the lease term. Depreciate over the lease term. But the standard says that if there is a purchase option in the lease, if there is a purchase option in the lease, and the lessee is reasonably certain to exercise the purchase option, if there is a purchase option in the lease. What is the meaning of purchase option? In the lease contract, a clause is there. In the lease contract, a clause is there that if lessee wants, then he has an option to purchase the asset at the end of the lease term. This is called as purchase option, okay. This is called as purchase option. This is called as purchase option. So standard says that if there is a purchase option existing, if the purchase option exists, and the lessee is reasonably certain that yes, at the time of lease, at the time when the lease term gets over, I will avail this purchase option. I will avail this purchase option. In that case, I will have to depreciate my right of use asset over the remaining useful life of the asset. Over the remaining useful life of the asset. Over the remaining useful life of the asset. Is that clear, everyone? Tell me. Is that clear, everyone? Tell me, guys. Come on. Now, let us take up an example. I'll draft a quite short example, but yes, it will help you in understanding each and everything. Okay, X Limited obtained a machinery on lease for 3 years. Okay, lease payments are $10,000 per annum or 3% of cash flow, whichever is higher. Okay, implicit rate at the rate of 10% and incremental borrowing rate of lessee at the rate of 12%. Okay, now the cash flows for 3 years are estimated to be year 1, year 2, year 3. $300,000, $400,000 and $500,000. Okay, now residual value is $50,000, not 50,000, 5,000, out of which $3,000 was guaranteed by lessee. Now, question here is point number 1, accounting treatment on lease commencement date. Second question here is accounting treatment over next 3 years, that is lease period. That is lease period. Now tell me, is the question clear to everyone? A quite easy question, but yes, I have tried to cover each and everything that can. Okay, so it will clarify all your all the points that I've covered so far. Tell me, you want me to solve this question now, or you want shall I give this question to you as an assignment? You can solve it off. I think that you can solve it off as an assignment also. Quite easy question, but yes, it will clarify all the queries. Tell me, what do you want, now or as assignment? Now or assignment? Okay, if it is now, then fatafat tell me what is the amount of lease liability. Solution. On lease commencement date, on lease commencement date, on lease commencement date, lease liability is equals to present value of 10,000 for 3 years. Second, 3,000 for third year, 3,000 at year end 3, right? At what discount rate? At what discount rate? Tell me, at what discount rate will I take? At what discount rate? 10%. I will take at 10%. Now tell me, what is my lease liability? What is my lease liability? Tell me firstly. 27122. I am assuming that it is correct. Okay, so the journal entry will be ROU account debit to lease liability. How much? 27122, 27122. Right now, subsequently, how will I amortize the lease liability? So I will prepare amortization schedule for that. Opening year, opening lease liability, finance costs, lease payments, and closing lease liability, right? Now, so tell me what is happening. Year, opening lease liability, finance costs, closing lease payments and closing lease liability. Year 1, year 2, year 3, opening lease liability is 27122. Finance cost at the rate of 10% will be there, right? So it is 2712. Lease payment will be 10,000, right? Now it will be how much? Tell me. 27122 into 1.0, sorry, 27122 into 1.1 minus 10,000 is equals to 19834. Okay, 19834. So it is 1983 minus 10,000 is equals to 11818. Now 11818, 1182 is minus, here it will 13,000. It becomes nil. Now this finance cost will be transferred to P&L. Okay, now what are the journal entries? What are the journal entries for all the 3 years? What are the journal entries for all the 3 years? Let me write here. Year 1, year 2, year 3. Okay, now first entry is finance costs account debit to lease liability, then lease liability account debit to bank. Okay, then third point, rent expense account debit to bank, then depreciation account debit to ROU assets. So these are the 4 entries which I will pass. Now what are the amounts for the 3 years? So the finance cost will be 2712, 1983 and 1182. Lease liability to bank will be how much? 10,000 and 10,000. Now tell me, actually how much we will pay, so 300,000 multiplied by 0.03 is 9,000. So we paid 10,000. So here there is nothing. Here we will nothing. We have paid 10,000 only. We have paid 10,000 only. So it's nothing here. Now second year 4,400,000 into 0.03 is 12,000. So we paid 12,000, but the what was considered as part of lease liability 10,000. So extra is 2,000. Extra is 2,000. So this 2,000 I will record as rent expense in P and L. Right. This will go to P and L. Right. Third year, how much we have paid? 500,000 multiplied by 3% is 15,000, but we have considered 10,000 as part of the lease liability. So I will transfer 5,000 to P and L as rent expense. Right. Now depreciation to ROU will be how much? 27122. 27122 divided by 3 is equals to 9041. 9041, 9041 and 9041. Done. So this is how I will record it. Tell me, is it clear everyone? I believe this question would have solved all the queries so far. I believe this question would have solved all the queries so far. And it would have given a clear understanding for each and every point that we discussed so far. Tell me guys, is it clear everyone? Is it clear everyone? Last year residual. हाँ ठीक है, that's what. Okay. Every time I have to remind you. What about 2K residual value? Not 2K residual value. So I will pay here 13,000. I'm so sorry. I will pay residual value also, right? I will pay residual value also. Yes. What about 2K residual value? Okay. Understand. Yes, understand. Yes, understand. Is your query is here, right? Residual value is 5,000, out of which 3,000 is guaranteed by the lessor. Understand? Yes, you have taken a flat, you have taken a machine on rental. Okay, yes, you have taken a machine on rental. Okay, now the lessor asks you that you have to pay 10,000 per annum. Okay, you tell, okay, fine, I will pay. The lessor says that from this asset, ideally I should get a residual value of 5,000, but since I am giving the asset to you, I will get a less residual value. So hence you have to give me 2,000 out of residual value. Okay, because it is a loss for me. So you will give 2,000 of residual value to the lessor. Now tell me, yes, tell me, are you, sorry, not 2,000, you have to give 3,000 to the lessor. You have to give 3,000 to the lessor. So now tell me, yes, are you concerned about the next 2,000? Are you concerned about the rest 2,000? What are you concerned that what is the amount that I am paying to the lessor? These are my lease payments, right? These are my lease payments. What I am paying to the lessor, right? This 2,000, are you paying to the lessor? No, you are not paying. You are not paying. So when you will hand over the asset to the lessor will sell the asset in the market, and from there he will realize 2,000. From there he will realize 2,000. Okay, so this 2,000 entry will pass by the lessor, not you. Okay, so now this the accounting treatment of this 2,000 we will discuss at SBR. Okay, we will discuss the accounting treatment of 2,000 at SBR. Is that clear everyone? Now coming back to our capsule presentation. Understand guys. So how things are presented in SOFP, not balance sheet, I write here SOFP, statement of financial position. So this is statement of financial position, and this is a statement of financial position, and this is a statement of profit or loss. Okay, now it's the extract. Okay, now it says that you have to record right of use as part of non-current assets, and this lease liability, since it's a financial liability, so you have to break this lease liability into non-current liability and current liability. And in the exam multiple times I have seen they ask question that please break this liability into what is the portion of non-current, what is the non-current portion of this lease liability, or what is the current portion of this lease liability. Okay, Queen has a query that what terms to catch for payment in advance or arrears? Is it difficult to ascertain whether payment is done? No, Queens. It will not be difficult. The question will specify that. Okay, question will either mention the terms like the payment are made in the beginning or the payment are made in advance. Okay, if nothing is mentioned, assume that the payments are made in arrears. If nothing is mentioned, assume that the payment are made in arrears. If the question specifies something, assume take that. If the nothing is mentioned, assume that the payment are made in arrears. Is that clear? Is that clear, everyone? Wonderful. Wonderful. Extracts of statement of profit or loss. But before I go to P&L, so I was discussing that lease liability you have to classify into current portion and non-current portion. Current portion and non-current portion. So how to classify that? Let me discuss that also. Classification of current and non-current. Lease liability. Okay, see, understand the lease liability, if it is in arrears, or if it is in advance, Queen, I told it multiple times in the class today also. I think someone asked previously also that mid-year is not in our syllabus. I have not seen any question in the mid-year. Okay, we have a question of arrears, we have a question of advance. Okay, we don't have any question on mid-year payments. Okay, if you go to your BPP test workbook or Kaplan study test, nothing is talked about the mid-year. Okay, in practical it can be anything, but from our syllabus perspective it is not there. Okay, so since it is a revision class, I'm not going to what is not relevant for the exams. And still, just to answer, even if the payment is made in mid-year, it will not impact the depreciation computation, but it will just impact when you are calculating the present value. It will just impact that. Okay, when you are calculating the present value, it will just impact that time. Otherwise no. Okay, now if it is arrears, then non-current portion will be equals to if the lease payment are made in arrears, then non-current portion will be equals to balance at the end of next year. Now let's suppose if the question is asking you what is the, let's suppose you have calculated the lease liability, the question is coming up, what is the non-current portion of lease liability on 31st December 2022? What is the non-current portion of lease liability? Let's suppose the question has given you the data of lease liability on 31st December 2022. Okay, let's suppose any amount is there. Okay, now what is the non-current portion of it? So it says that non-current portion will be equals to the lease liability on 31st December 2023. Now what is your current portion? Current portion will be the balance part. Okay, balance part. Okay, now so let me write here what is the current portion. Current portion will be equals to the total lease liability minus non-current portion. Right, now if the lease payments are made in advance, then in that case current portion of the lease liability is equals to lease payments in next 12 months. Okay, and what is the non-current portion? the non-current portion will be equals to total lease liability minus current portion. Just have a look at it and tell me, is it clear, everyone? Have a look at it and tell me, is it clear, everyone? Is it clear, everyone? I can see queries from SBR coming in here. Okay, dismantling cost. Salman is asking, dismantling cost included? Yes, dismantling cost gets included, but at FR level it is not there. Okay, guys, from now onwards, if I see any queries coming up from SBR level, I will not be taking it up here. The only reason here is it will confuse the FR students. So I don't want to do that. Okay, I don't want to do that. Is there any sum where interest is paid in advance? Interest is paid in advance and also in arrears. Interest is paid in advance? Queen, what are you talking about? How come interest? We are talking about lease payments. And how come one contract have advance and arrears? Both. Either you can pay in arrears or you can pay in advance. How can there be both? Will you pay twice? For year 2023, will you pay the rental twice? No, right? So just I am taking a simple example of it to explain. Okay, now lease payment are 10,000 per annum, arrears in arrears. Okay, and for 3 years. Okay, so now, so lease payments are 10,000, 10,000, 10,000. Now, can you tell me what is the lease liability here? What is the lease liability here? What is the lease liability here? Queen, again, I'm telling, finance cost is nothing. Okay, you are paying. See, you understand this journal entry. Okay, you have to record finance cost, increase the lease liability, and then pay the lease liability. And then pay the lease liability, the contractual lease payments you have to pay. There is nothing that finance cost separately gets paid. There is nothing concept like that. Okay, there is no such concept like that. Okay, you are paying the contractual lease payments. Now, 10,000, 10,000. Can you calculate the lease liability on this date and tell me what is the amount of lease liability? So 10,000. Okay, or you can calculate the lease liability here. What is the lease liability here? Tell me. At the discount rate is 10%. You can write discount rate is 10%. So 1.1 divided equals to GT divided 10,000, 24868. Now, if you have to do the bifurcation, what is current and what is non-current? What is current and what is non-current? Now, so for finding that, you have to calculate what is the balance here. What is the balance here? What is the balance of lease liability here? So you will find 24868 into 1.1 minus 10,000. So it is 17355. The lease liability balance is 17355 here, right? So this will become your non-current. What is current? So the balance is 24868. 24868 minus 17355 is equals to 24868 minus 17355 is equals to 17513. 7513 is the current part. Now, taking another example, lease payment are 10,000 and 3 years. The lease term is 3 years. Okay, in advance, the lease payments are paid in advance, and discount rate is 10% again. The discount rate is 10% again. So now 10,000 you are paying here, 10,000 you are paying here, 10,000 you are paying here. So what is the lease liability here? It is 27355. Now what is the lease liability here? 27355 into 1.1 is 30090, if I'm not wrong. Sorry, just a minute. 1.1 divided by this GT into 10,000 plus 10,000 plus 1325 minus 10,000 to 1.1 is 19090. Sorry, it is 19090. 19090, right? 19090 is the value. Now if you have to divide it into current and non-current, so current will be 10,000 and the non-current will be 9090. This is how you will do it off. Tell me, is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Tell me. Because see, on standing on this date, on the very next day, see, this is year 1. See, this is year 1. This is year 1 and this is year 2. This is year 2. This is year 2, right? The green one is year 2. Or this is year 2. This 10,000 is paid in year 2, not year 1, right? So now you this 19090, the balance which you have calculated is at year end 1. Let me write that here. It is at year end 1, but this is paid at beginning of year 2, right? So that's why I say that 10,000 is current and 9090 is the non-current part. So this is how you will do the classification of current and non-current. Moving back to my concept capsule. In P&L, you will transfer depreciation expense, finance cost on lease liability, depreciation cost on ROU, and rent expense. What is the meaning of rent expense? Any variable lease payments or any lease payments which was not considered in calculating the lease liability are the lease payments which will be transferred to P&L as rent expense, right? So variable lease payments are not considered in calculating lease liability, okay, and lease payments for the lessee recognition exemption will be recognized in P&L as rent expense. What is recognition exemption? I have not yet discussed. I will be discussing it, but so far I have not discussed it. Is it clear, everyone? First year is upfront. Just a minute. Upfront. Yes, if you want, you can. If you see how I have calculated 19090 is, first of all I have minus. So it is 17355, okay. Then I added 10% of 17355, okay, and then I arrived at 19090, okay. Just for the sake of completeness, I showed it, but you guys are correct. I totally accept that you guys are correct, but just for the sake of completeness, I have added it. If the question asks you what is the lease liability here, you should give the figure of 17355 itself. Okay, if the question asks you what is the lease liability on this date, it is 17355. It is not 27355. But just for the sake of explaining, I wrote 27355. I believe it should not be a query in that case. Is that clear, everyone? Yes, Vaisali, is that clear to you guys? Okay, in this case, on lease commencement date, you will pass the entry like this: ROU account debit to lease liability to bank. ROU will be 27355, lease liability will be 17355, bank will be 10,000. Now is it clear? Wonderful. Now coming to recognition exemptions. Now understand what is the recognition exemption. Basically, the standard so far what they have done is saying that if you have taken any property or if you have taken any asset on lease, you have to record an asset and you have to record a liability. If you have taken any asset on lease, you have to record an asset and you have to record a liability. Let's suppose I have taken a property on rent. I have taken a flat on rent for 11 months. What to do now? I have taken a property on rent for 11 months. Tell me what to do now. Shall I capitalize that? Shall I record an asset and I record a liability for that? No, it's for 11 months, right? So standard says that if you have taken, first of all, this exemption is only for the lessee. Now standard says that if you have taken an asset on lease for short term. What is the meaning of short term? The lease term is up to 12 months and there is no purchase option in the lease, okay? The lease term is up to 12 months. Up to 12 months means 12 months is also included. Means that if the lease term is 12 months, if the lease term is 12 months, you can apply this. You can apply this, okay? Or it is not and, it is or, meaning that if either of the two conditions get satisfied, you have the exemption. Or second condition is the lease of the low value item. I have taken a mobile phone on rental. I have taken a mobile phone on rent. I have taken this mobile phone on rent, right? So now if you take this mobile phone on rental, if you take this mobile phone on rental, or if you take a property on rental for a small period or for a short period, standard says that there is no need to capitalize the asset and record a liability. Rather, what you can do is whatever amount you are paying as a lease payment for the assets which you have taken on a short period or for low value has to be recognized in P&L as rent expense. In P&L as rent expense. Now understand one thing. Lease payments, or I'll say here, I'll write here. Lease contracts, okay, or of short term, or they are of low value, okay, or they are of low value. Whatever lease payments are there, they will be transferred to P&L, okay, they will be transferred to P&L. Now again, if you have all other contracts, you will recognize what? You will recognize ROU account debit to lease liability. But there is again an exception. The exception is variable lease payments. Variable lease payments will be transferred to P&L on actual basis as rent expense. Now understand one point. See, this variable lease payment is also transferred to P&L as rent expense, and this lease payment is also transferred to P&L as rent expense. But there is a difference between the both. What is the difference? This P&L will be this lease payments will be transferred to P&L as rent expense on straight line method basis, SLM basis, okay, but they will be transferred to P&L on actual basis. This is on a SLM basis, this is on actual basis. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me, guys, come on. Okay, now you must ask me, what is the meaning of SLM basis? See, actual basis I have already explained, right? 2000, 5000, if you can remember, 2000, 5000, I already explained actual basis, right? Now SLM basis I will explain. Let's suppose you have taken a mobile phone on rent, rental, okay, for 3 years, okay. The lease rentals were for year 1, year 2, year 3, it was 5, 10 and 15,000, 5,000, 10,000 and 15,000. Now tell me, what is the amount that will be recognized in P&L? Total is how much? 30,000, right? So you will recognize in P&L 10,000, 10,000, 10,000 rather than 5, 10, 15. You will recognize in P&L 10,000, 10,000, 10,000 as a rent expense. So what is the entry? What are the entries? So on this year you will record rent expense account debit 10,000, okay, to bank, how much? 5,000, to liability, how much? 5,000. I have not paid 5,000. Now here you will record rent to bank 10,000. Here you will record rent expense account debit 10,000, okay, liability account debit 5,000, to bank, how much? 15,000. Now understand, the total amount which I am recognizing in P&L and the total amount which I am paying are the same, but the timing differs. The amount differs, okay. The per year amount differs. This is what is the meaning of SLM basis. I believe it is clear to all of you now. I believe it is clear to all of you now. Actual basis basically means 5,000 transfer to P&L, 10,000 transfer to P&L, 15,000 transfer to P&L. Okay, actual basis means whatever I am paying, I will have to record in P&L. Whatever I am paying, I will have to record in P&L. Okay, whatever I am paying, I will have to record in P&L. Actual basis. Okay. Dakshesh is asking, so it means that for 1 year contract compulsory, I need to pass ROU to LL. Now understand, if it is 1 year contract, tell me what I told. Short term lease means up to 12 months is a short term lease. So 1 year means up to 12 months, right? 1 year means what? 12 months, right? So it means it is short term lease. It can be short term lease. Now it can be short term lease, right? See, lease term up to 12 months. Up to 12 months is a short term lease. Okay. Now means till 1 year is a short term lease. Okay, and no purchase option or a tablet, laptop, tablet, computer, mobile phone. All these are low value assets. Okay. Now, if the lessee opts for this exemption, then lease payments are to be recorded as expense, rent expense in statement of profit or loss on either straight line method or any other systematic basis that is more representative of the lessee's benefits. Is it clear everyone till here? Is it clear everyone till here? Now tell me guys, come on. Is it clear everyone? Wonderful. Now, one last concept and this standard is over. One last concept. Then there's definitely one small point is there after that also, but one last concept. Sale and lease back. Sale and lease back. What is the meaning of sale and lease back? What is the meaning of sale and lease back? Means, sir, if there is a purchase option, then we'll record ROU asset. If there is a purchase option, then yes, you have to record an ROU asset, because it will not classify under short-term lease. Okay, but purchase option, if purchase option is there, yes, you have to record ROU asset. Okay, unless and until it is a lease of short-term lease. It's a lease of low value assets, not short-term. It's a lease of low value assets. Then yes, we have to record. Sale and lease back. Now, what is the meaning of sale and lease back? Means I had the asset, I first sold the asset and then took the asset back on lease. First I sold the asset, then I took the asset back on lease. Okay. Now, a classic example of is Indigo. This concept was introduced also because of Indigo itself. Now, Indigo, when it started operations in India, what it did is he needed the flights. Okay. And what he thought that when Indigo started its operations, all the companies in the aviation sector were into losses. Okay. So what Indigo thought that I will take the flights on leases. Yes, Dakshesh. Okay, so I will take the flight on leases, but German company who used to manufacture the flights definitely not trust a new startup company, right? Will definitely not trust for such a high value, right? One flight comes somewhere in the range of 2,000 crores in INR. Okay, so it's a very high value, and when these companies like Indigo purchase flights, they purchase around 200-300 flights. So it means what? 4 lakh crores in INR, right? That's quite a big amount, right? Definitely no one will trust a new company for this big amount, right? So German company denied that I will not give it to you. So what Indigo did, Indigo purchased asset from German company. When Indigo purchased asset from German company, now the challenge with Indigo was, definitely Indigo had the asset, the flights, but Indigo had cash crunch. Okay, cash challenges. So what Indigo did was, Indigo sold the flight to bank and repaid the amount to the German company. Okay, so cash crunch is resolved now, but again I don't have the asset. So what it did is it took the flights on lease from the bank. Okay, so this is called a sale of the asset to the bank, and then again taking the asset back on lease. Okay, sale and then take the asset back on lease. Sale and then again take the asset back on lease. Okay, now I'll discuss it. So it is sold, and then it is taken back on lease. Then, but now understand, if now today itself we are going to discuss revenue, and in the revenue we discuss that Tell me, when can we recognize control revenue? Tell me, when can we recognize revenue? When the control is transferred, right? When the performance obligation is satisfied. When can we recognize revenue? When the performance obligation is satisfied. Now, when can we assume that the performance obligation is satisfied? When the control is transferred. So standard says that I will understand that this is a sale transaction. I will understand that this is a sale transaction if it qualifies the meaning of transfer of control as per IFRS 15. Okay, if the control transfers from Indigo to State Bank of India, okay, it is then I can say yes, it is a sale transaction. Otherwise it is not a sale transaction. Otherwise it is not a sale transaction. Let me explain it. Let's suppose Indigo, and this is a bank. See, when they do the transaction, they are not at all aware. They are not. See, understand. I always tell in my regular classes that the accounting is governed as per the business. It's not the other way around. The business is not governed as per the accounting. Okay, accounting is governed as per the business. Business is not governed as per the accounting. Okay, now let's suppose. Now they are discussing the founder of the CEO of Indigo and CEO of SBI Bank. They are sitting and they are discussing the terms and conditions. Now tell me, do you think when they are discussing the terms and conditions, they will think about IFRS? Tell me, do you think they will think about IFRS? Tell me. When they are discussing the terms and conditions, they will think about the IFRS? No, they will not. They will not. Okay. Now what they are saying is, Indigo says that I will sell the asset to you. You give me the money of $100,000. Okay. Now then what you do is you give the asset to me. Okay, you give the asset to me on lease, and I will give you lease payments. Now understand, if this sale, this is what is the contract. This is as per the contract. This is what is the contract. This is the contract. This is the contract. Now, once the contract is signed, after that, now I am assessing it off. Now I say that okay, this sale satisfies the transfer criterion, satisfies the transfer of control criterion, and hence this is a sale transaction. So I will record the journal entry for sale. I will record the journal entry for lease back. Fine. But now let's suppose this sale does not qualify. That control transfer criterion. Now it means it is not a sale transaction. If it is not a sale transaction, means tell me who has the control of the asset? Tell me, Indigo or SBI. If this is not a sale transaction, who has the control of the asset? Tell me, Indigo. Right, Indigo. Now Indigo has the control. Can Indigo take the asset on lease from himself? No, right? So this is not a lease. This is not a lease transaction itself. So now what is happening? See, I have received 1 lakh and I am paying the lease payments in installments, right? I am paying installments. So it is like a financing transaction. Coming back to my notes. So its standard says that if the sale qualifies the control criterion, it is a sale and leaseback accounting. If it does not satisfy the control criterion, it is a financing arrangement. Is that clear, everyone? Tell me, guys. Come on, tell me. Is it clear to everyone till here? Is it clear, everyone? Now, tell me, how do you measure your lease liability? The lease liability is measured. Okay, fine. I'll explain this way. If it is a financing arrangement, fine, you can do the accounting of it, fine. Now, I am discussing about sale and leaseback accounting now. Sale and leaseback has two aspects. One is sale and one is leaseback. Sale means what? Sale means what? Sale, the entry is what? Bank account debit to lease. Sorry, not to, sorry. Bank account debit to asset. Bank account debit to asset to gain or loss on sale. To gain or loss on sale. Tell me, is it clear, everyone? Is it clear, everyone? The entry for sale. Now, what is the entry for lease? What is the entry for lease? Entry for lease is ROU account debit to lease liability. Tell me, these two entries are clear to you? Are these two entries clear to you? Right? Now, if in these two entries, this here you will write what? Sale proceeds. Here you will write what? Carrying amount on date of sale. Here you will write what? Balancing figure. Now, lease liability, how will you calculate? Lease liability, how will you calculate? Present value of future lease payments. Now tell me, is it clear? Everything till here? Is it clear to everyone till here? Tell me, guys, come on. Now, let us discuss about ROU. Let us discuss about ROU. Now, tell me, is it correct? Let's suppose I had an asset with the carrying amount of which was 100. Okay. I sold it for 150. I sold it for 150 and recognized gain of $50. I recognized gain of $50. Okay. Now, when I took it back on lease, my present value of future lease payments comes to 80. Okay. For this asset, the remaining useful life of this asset was 5 years. Okay, I have taken the asset back on lease for 3 years. Now tell me, do you think recognizing the asset at 80 is correct? Recognizing the asset at 80 is correct? Hers, I will come back to that, no worries. But tell me, first of all, let's discuss on this part. Recognizing the asset at 80 is correct? No. Why? The standard says that since you had the control of the asset, which you lost when you sold the asset, but when you took the asset back on lease, you obtained a percentage control of the asset. Not the entire control, but a portion of the control you have reacquired. You have reacquired a portion of the control. You have reacquired a portion of the control of the asset. So hence you have to record the asset at its proportionately. So how you will record the ROU? So you will record ROU at the proportionate of carrying amount, okay, for the control that you have regained. Now, how will you calculate what is the control that you have regained? So standard says that, first of all, tell me what is the price for 100% control. That is called as fair value of the asset. Now, how much control you have acquired in the lease transaction? So now tell me, out of the fair value, how much you have paid? You have paid lease liability. So this will be your ROU asset. Right? This will be your ROU asset. Is it clear, everyone? Tell me, guys. Now, next part. Now, understand one thing. The journal entry for sale and lease back. Journal entry for sale and lease back is bank account debit, ROU, asset account debit, or I have written here, I will not write it again, no point writing it again. Bank account debit, sale proceeds, ROU account debit. How come ROU? Carrying amount of the asset multiplied by the lease liability divided by the fair value of the asset. Okay. Now, to lease liability at present value of the future lease payments. Okay. To asset, I will de-recognize the asset. Okay. Carrying amount of the asset on the date of sale and lease back. Okay. Gain or loss on sale and lease back is the balancing figure. Now, understand, guys. This is definitely the journal entry. Sometimes the question asks you, what is the gain or loss on sale and lease back? Understand. Okay. when you sell the asset, when you sold the asset, you lost 100% control. Okay, and you recognized gain or loss on 100%. Okay, now when you reacquired the asset on lease, you acquired X percentage control of the asset. And hence here you have to reverse the gain or loss to the extent of X percentage. Right now. Okay, now so what is your gain or loss on sale and leaseback is equals to, what is the gain on sale of asset multiplied by 1 minus what? X. And what is X? What is the value of X? Lease liability divided by fair value of the asset. Okay, that is 1 minus control regained. 1 minus control regained. Okay, control regained means 1 minus, meaning thereby you will, this is the gain or loss on sale of the asset, and this portion ensures reversal of gain or loss to the extent of control regained. Now tell me why I am doing this adjustment. Tell me, you recognize gain or loss on the percentage transferred or the percentage retained. Tell me. In the building, if you have 3 floors, you sold only 1 floor, 2 floors you are not selling. So you will record the gain or loss on entire 3 floors or only on 1 floor. Tell me. You will record the gain or loss on entire 3 floors or only on 1 floor. Tell me. You have sold only 1 floor, so you will record gain or loss only on 1 floor, right? Similarly, you have an asset, so for which you have first sold all the 3 floors, then you reacquired 2 floors, okay? So standard says that you are required to recognize gain or loss only on the 1 floor which you have sold. Okay, that's the reason why we are doing this adjustment. Okay, so this completes this one. Now identification of lease. Tell me guys, is it clear to everyone till here? Anyone having any queries so far? You guys are not giving me boosters today. You guys are not giving me boosters. Is it clear, everyone? Thumbs up. Okay, fine. The last topic for the leases. Identification of a lease. Tell me, when will we do this identification of lease and on what date? On what date will we do identification of a lease, whether this contract is a lease contract or not? On what date? Very good, Nishan. Very good, everyone. We will do it on lease inception date. See, that's what I've written here. At the inception of the contract, an entity shall assess whether the contract is or contains a lease. For a lease to exist, it should satisfy all the 3 conditions. Okay, so this needs to be assessed on the inception of the contract. Okay, when the contract starts, when the contract is signed on the very same day, I have to assess whether this is a lease contract or not. The lease accounting starts from what date? The lease accounting starts from what date? The lease accounting starts from what date? Come on guys, tell me the lease accounting starts from what date? It starts from lease commencement date. Okay, now so it says there are three conditions which needs to be satisfied for a contract to be a lease contract. There has to be an identified asset, there should be a right to obtain substantially all the economic benefits from the use of the asset, and there has to be right to direct the use of the asset. Okay, meaning thereby the asset should be an identified asset, and the I should have the right to direct the use of the asset. Who is having the right to direct? The lessee should have the right to direct the use. Who has the right to obtain substantially all the economic benefits? Lessee should have the right to obtain substantially all the economic benefits from the use of the asset. Okay, if all the three conditions are satisfied, then we can say that this is a lease contract. Queen, understand that we will do assessment whether it is a lease contract or not on lease inception date. We will do the accounting of lease on lease commencement date. Now, what is the meaning of identified asset? What is the meaning of identified asset? So it says that for an identified asset to exist, it must satisfy all the three mentioned conditions. Again, what is it should be explicitly or implicitly specified. Okay, it should be explicitly. I am not writing here conditions, rather it will confuse you. Okay, ignore this point also. Again, it's from SBR perspective. Okay, now for an identified asset to exist, it says that for an identified asset to exist, it should that the asset should be explicitly and implicitly specified, and supplier not to have substantive substitution rights. Supplier not to have substantive substitution rights. Now let's suppose when you are signing a lease contract, don't you think in the contract it should specify which is the asset which is given on lease? What is the asset which is given on lease? Right? So now, so it says it should be specified in the contract either implicitly or explicitly. Now you should ask me, what is the meaning of explicitly and implicitly? Explicitly means, let's suppose I have taken a flat on rent. Now in the contract it is mentioned flat 201 is the flat given on rental to Vishal Jain. Now what is the meaning of implicit? So implicit means the flat is still under construction, so I cannot write this is the flat that this is the flat which will be given on rental to Vishal Jain, but both the lessee and the lessor are aware that okay, this is the flat which will be given on rental to lessee. Supplier not to have substantive substitution rights. Now let's suppose I took this mobile phone on rental. I took this mobile phone on rent. Okay, now what happened? The person from whom I took this mobile phone on rent has, every second day he comes and says that Vishal, I need this phone, you take another phone, I will give you another phone, but you give me this phone, so he basically replaces the phone every another day. Right? So it means that the supplier, the lessor has the right to substitute the asset. Okay, if the supplier or the lessor has the right to substitute the asset, then it is not an identified asset. Okay, in my regular classes I give the example of the vendors, the local vendors. Like for example, if you have visited the railway station, there is a vendor who sells magazines, or you can say some books, right? Comic books or magazines, right? His stall is there on a moving vehicle, right? So he also pays a rental for that space. But is that an identified asset? No. Sometime his stall is in this place, sometimes his stall is on that place. So this is not a lease contract. Why? Because there is no identified asset that he gets. But now in the same railway station, there is a proper shop for comic books. Okay, so now he has also signed the contract with the railway authority, right? Now that contract might be a lease contract. Why? Because that asset is not you can say cannot be substituted, right? He has an identified asset. Right? Now, right to obtain substantially all the economic benefits from use. Now tell me, under the lease contract, I have got the right to use or I have got the right to ownership? Tell me what I have got. I have got the right to use. So it's standard says that you will get all the benefits from using the asset, not from ownership. All the benefits from using the asset. Okay, so a customer means lessee. A lessee can obtain economic benefits either directly or indirectly. Now these benefits should be from use only. You cannot get the benefits from ownership of the asset. Okay, Now the right to direct the use. Let's suppose if I have taken a flat on rental. Now this flat, how I am using this flat, how I am using the flat is I will determine that, right? My landlord cannot come and say, right? Now understand, definitely this flat is a residential flat, so I can use it for residential purpose only. I cannot use the flat for commercial purposes, right? I cannot use the flat for commercial purposes. Or if I have taken a flat for commercial purposes, then I cannot use it for residential purposes. That is something deemed. Okay, now, but now let's suppose I've taken a residential flat. Now in that case, the landlord cannot come and ask that why you are using the flat in this manner, that manner. No, I have the right to use. I have the right to use the asset. Okay, so no one can intervene in that. Okay, so I will determine how and for what purpose the asset will be used. Okay, where and when the asset will be used, I will determine that. I means lessee. Protective rights. Now understand, when I will this is a real life example which I give in my regular classes. Again, let's suppose what happened some time back. I took a car from Zoom Car. Okay, I rented a car from Zoom Car. Now when I was going through the contract, in the contract it was mentioned that you cannot take this vehicle out of the premises of the Bangalore city. Okay, you cannot drive more than 2000 kilometers per day. Why? Tell me why they are restricting the use. Why they are restricting the use? To protect their interest in the asset. To protect their interest in the asset. Okay, that's the reason they are basically. Let's suppose if you have a laptop which you have given to someone else, don't you think you will tell him? Boss, see, I'm giving you my laptop. Okay, you need it. I'm giving you my laptop, but please use it properly. Okay, please use it properly. It's a new laptop. It's a brand new laptop. So please use it properly. Okay, please use it properly. So that similarly, if I'm taking any asset on rental from anyone, so that person will also tell me that please use it properly. Okay, to protect its interest in the asset. So these are called as protective rights, and they do not change the classification of a contract being a lease contract. Now, these even though these restrictions are there in the contract, still it can be a lease contract if they satisfy these three conditions. Now, tell me, is it clear to everyone till here? Is it clear to everyone till here? Revision in 1 hour and 43 minutes. Not bad. Tips from the examining team. If the question asks expense related to the lease, depreciation cost plus finance cost. If the question asks expense related to lease liability, you have to write finance cost only. If the question asks expense related to the ROU asset, then again you have to write depreciation cost plus finance cost. Okay, first point. Second point, be careful if the lease payments are made in advance, that is beginning of the year, or arrears, that is at the year end. In case the lease payments are in advance, if the question provides you the present value of the lease payments, check whether it includes the present value of the payment made in advance, that is the very first payment. Okay, I think this is what I discussed. Vishali was also asking me, right, in the 27355 or 17355, right? It might use such words. Present value of the future lease payments means it will have 17355. Present value of the total lease payments, it will write 27355. So please be very careful. Please be very careful in reading what the question says. Is it saying future lease payments or is it saying total lease payments? So please read the question clearly, properly. Is it clear, everyone? Is it clear, everyone? Guys, I emphasize it multiple times in my regular classes, and I will emphasize it right now also, that please read the question properly, because one single word can also change the entire question, entire answer. Okay, so please read the question properly. Okay, and in the lease questions you have to find very carefully, read very carefully whether the lease payments are made in beginning or end. Okay, or at end. Okay, now if the lessee has paid any initial deposits, add to the ROU asset and then depreciate it off. This completes my lease standard. Tell me, is it clear, everyone? Anyone having any queries so far? Anyone having any queries? Come on, guys, tell me. No. Wonderful. Financial instruments. I'll tell you one thing. Though I have made a note specifically for you guys, but for financial instruments, in June 2023, I have taken live revision session for financial instruments for SBR. I've not taken it for FR, I've taken it for SBR. Okay. Now what you have to do is you have to refer these notes. I'm giving you notes. You have to refer these notes and just run through that video. Whatever points you find that it is not there in this video, just skip that part and go ahead, because unnecessary repeating the same thing, making the same content in the video in the YouTube will not make any sense. Okay. If it is already there, please use that. Okay. I will utilize my time in better discussion of the other topics. Is that clear, everyone? Tell me. Okay. And what I'll do is I will paste the link of this video in my description box. In the description of this video, I will paste the link of this video. Is that clear? Will you manage with this video? Tell me. Okay, but now you have to make a promise. Now you have to make a promise. Okay, that all of you will watch this session today itself. Tell me, will you do that? Because if you leave, it will be left. If you leave, it will be left. So let's promise. Please promise. Come on, guys. Tell me. You will watch this session today itself. Okay. Since I have taken in the June itself, so I don't want to take it again and again. Okay. So, but I have made the notes for you guys. Okay. But I will discuss one point with you guys. See this point. In financial instrument chapter, generally students ask me query that sir, I am confused between where to use which discount rates. So just what I have done is I have made up a summary for you guys. Will that help? Will this summary help you guys? Tell me. Will this summary help you guys? Come on, guys, tell me. Okay, you asked. See, you asked, I gave. Anything for you guys? Now, the third topic is revenue from contract with customers. The revenue from contract with customers. Now, tell me, before I start this topic, do you guys need a break or we can continue? Tell me. Do you guys need a break or we can continue? Even if we are taking a break, we'll take a break of 5 minutes only, not more than that. Tell me. Break. Okay. I'm giving you a break of 5 minutes now. Okay. Only 5 minutes. And please be back. Okay. After 5 minutes, all of you, please be back. Okay. Let's resume back, guys. Let's resume back. So topic number third for the day is revenue from contract with customers. Welcome back. Yes, welcome back. Now, okay, let's start with some activity. Tell me, what is the standard number of this revenue? What is the standard number of this revenue? High. What's the Joes? High. The Joes is very high. Monica, very high. Too high. IFRS 15. Good. Okay, now. So this standard is quite a easier standard, Okay, now let us start the discussion of it. So before we start the discussion, we have to understand the meaning of the standard. The meaning has the name has three words: revenue, contract, and customers. Now in the framework we study what is the meaning of income. Tell me, what is the meaning of income? Income are something which increases my assets, reduces my liabilities. As a result, my equity increases. Now equity can increase due to two reasons, right? Due to profits and due to contribution from the promoters, right? So it says that increase in assets, decrease in liability, resulting in increase in equity, except for contribution from promoters, right? This is called income. So revenue is an income. Revenue is an income. But are all income revenue? No. Are all income revenue? No. Income arising from the ordinary activities. Okay. Now the fees that you guys give me is an ordinary activity, so it is my revenue. Now let's suppose this calculator gets is not working properly, so I sold the calculator. The profit on sale of calculator, is it my revenue? It is my income, but it is not revenue. It is income, but it is not revenue. Okay, so there is a difference in revenue and income. So all revenue are incomes, but all incomes are not revenue. All incomes are not revenue. Okay, all incomes that come from ordinary activities are revenue. Now, what are contracts? Contracts are legally enforceable agreements. What are customers? Customers are the parties that has contracted with the entity to obtain goods or services produced by the entity in the ordinary course of business. Okay. So, who are customers? Customers are something who give me revenue. Customers are the parties who have entered into contract with the entity for purchasing the goods or services which are sold by the entity in the normal course of business, in the ordinary course of business. Okay. Now, what is the core principle of IFRS 15? What is the core principle of IFRS 15? So, core principle means recognize revenue in an amount that represents consideration that the entity will be entitled in exchange for the transferred goods or services. Okay, meaning thereby we are not required to assess what is the consideration that I have received. Rather, we are required to assess what is the consideration that I will. Okay, understand it like this. I am not required to assess or think or see what is the consideration that I have received. Rather, I am required to assess what is the consideration that I am supposed to receive for the transferred goods or services. Okay. Now, to state that in Hindi, कितना मिला उससे मतलब नहीं है, कितना मिलना चाहिए था उससे मतलब है. ठीक है, चाहिए था किसके लिए? फॉर द ट्रांसफर्ड गुड्स और सर्विसेज. ठीक है, मैंने जितना गुड्स और सर्विसेज ट्रांसफर किया है उसके लिए मुझे कितना मिलना चाहिए था उससे मतलब है, एंड हम लोग उतना रेवेन्यू रिकॉग्नाइज करेंगे. ओके, व्हाट वी हैव रिसीव्ड डज नॉट मैटर. व्हाट वी आर सपोज्ड टू रिसीव फॉर द गुड्स और सर्विसेज दैट हैव ट्रांसफर्ड इज व्हाट मैटर्स. ओके, now just now I recalled, Karan, I think I missed to take up your query. No worries, after the class you can just give me just drop me WhatsApp. Okay, I'll take up your query, Karan. Okay, just now I recalled. Yes, so basically it means accrual concept. Now, this accrual concept is satisfied by way of 5 steps. By way of 5 steps. Now, what are the 5 steps? These are the 5 steps. So, first of all, I have to identify. If the contract is there or not. Now, why am I identifying a contract is there or not? Now, understand. In the concept of accrual, I have to see that the promises which I have made as an entity to my customer, or the promises which the customer has made to me, we both are binding on that or not. Now, if there is no contract, we are not bound by anything. Right? So, right, the accounting then will become difficult. But if there is a contract, then I am bound by the promises that I have made, and the customer is bound by the promises that he has made, right? So, both of us are bound by the promises that we have made to each other. So, that's what is the relevance of contract, nothing else. Okay, the importance of contract is only to the extent that the entity and the customer are bound to each other for the promises that they have made to each other. That's all, nothing else. Okay, nothing else. That's what is the relevance of contract. Now, after assessing the contract is there or not, then I will assess what are the obligations of the entity. Now, tell me, let's suppose I am entity. Tell me, what is my obligation towards you? What is my obligation towards you? To deliver you the FR classes, to deliver you the SBR classes, right? This is my obligation. Okay. Now, what is the transaction price? Means the amount that an entity received from the customer, the contracted price. When I'm saying transaction price, I'm saying what is the price that is contracted with the customer. Okay, contracted price. So, first, there are 3 steps. 3 steps are like this. First of all, identify contract. The relevance is to make each party bound to each other. Now, okay, this is step number 1. Now, step number 2, identify performance obligation. Means what is the obligation of the entity towards the customer. Okay, now to teach financial reporting. Now, what is determined transaction price? Means the fees that you have given me. is the transaction price. Okay. Now, allocate the transaction price to each of the performance obligation. Now, in our case, there is only one performance obligation. So, this entire fees is allocated to this obligation. Okay. So, now in cases like let's suppose take up an example. You purchased a laptop. Okay, you purchase a laptop, and alongside the laptop you purchase one additional keyboard also. Right? So you are purchasing 2 things, right? And cumulatively for both of them you are paying $6,500. So now transaction price 6,500, obligations are laptop and keyboard. Now you have to analyze how much of 6,500 is for the laptop and how much of 6,500 is for the keyboard. So allocate the transaction price to the performance obligation and then recognize the revenue as and when the performance obligation gets satisfied. Okay, as and when. Let's suppose when you transfer laptop, recognize the revenue for the laptop. When you transfer keyboard, recognize the revenue for the keyboard. It doesn't matter when you have received the money, doesn't matter. Okay, but what matters is when you are transferring the goods or services, it is on that date you have to recognize the revenue. When you are transferring the goods or services, it is on that date you have to recognize the revenue. Is it clear, everyone? Tell me. Is it clear, everyone? The 5 steps are clear to all of you? Tell me. The 5 steps are clear to all of you? Tell me, guys. Come on. Now, let's take up an example to understand these 5 steps. It says what? X Limited intend to contract with a customer for sale of a software and 3-year technical support. So now there are 2 performance obligations. Performance obligation number 1, okay, and now someone has made a channel name itself with my name. Friend of C. Vishal Jain. Hey, who is this guy? Someone has made a channel itself with my name. Anything can happen these days. Okay. Sale of software, performance obligation number 1, and 3-year technical support is the performance obligation number 2. Okay, services at a price of INR 30,000. Okay, so this 30,000 is the transaction price. Further, software and 3-year technical support services are sold separately for INR 20,000 and 15,000 respectively. Analyze. Now, step number 1, contract. Step number 1 is contract. So, assume contract exists. Yes, I am. Okay, assume contract exists. Step number 1, assume contract exists. Step number 2, assume 2 performance obligation. Performance obligation number 1 is sale of software, and performance obligation number 2 is sale of 3-year technical support services. Now, step number 3 is transaction price. Okay, so what is the transaction price? Transaction price is 30,000. Allocate the transaction price. Now, understand this 30,000 you have to allocate to performance obligation number 1 and performance obligation number 2. Okay, how will you allocate? So, standard says that this allocation has to be done in the ratio of standalone selling price. In the ratio of standalone selling price of each performance obligation. So, how will you allocate? 30,000 multiply what is the standalone selling price? See, it is given. See here. Okay, are sold separately for 20,000 and 15,000. So, it is 20,000 divided by 35,000. How come 35? 20 plus 15 is 35. Now, again 30,000 multiplied by 15,000 divided by 35,000. So, what is the amount? 30,000 into 20 is 17143. And what is the amount? 12857. So, how will you recognize the revenue over 3-year period? Right now, see what happens here. The software you are transferring here itself, and the whole amount you have received here. See, bank account debit 30,000 you have received here itself. But now you are just transferring software here. So, we will recognize how much revenue is 17143. What about the technical support? Are you transferred now? No. So, we will record as contract liability or deferred income. Contract liability or deferred income. Or deferred income also it can be said. Okay, deferred income. How much? 12857. Now, on each reporting date, this one and this one, I will pass journal entry as deferred income account debit to revenue. Deferred income account debit to revenue. How much? 12857 divided by 3 is 4286. 4286, 4286 and 4286. Contract liability or deferred income, both are the same. Okay, is it clear, everyone? So, this is how I will recognize the revenue. Okay, so the purpose of this 5-step model is to tell you 3 things. The purpose of the 5-step model is to tell you 3 things: when, amount, and how. Okay, so when do you need to recognize revenue? See, though you have received the 30,000 here, but partially you are recognizing now and partially you are recognizing in the future. When? Amount, see here, see amount. Okay, you are recognizing 17143 here, 4286 here, 4286 here and 4286 here, right? This is giving me the amount. How? I will be answering. How I have not answered, how I will be answering. But see, this is the purpose of the 5-step model is to give you the answers for the 3 questions. When you have to recognize revenue, what amount of revenue you have to recognize, and how you have to recognize the revenue. Is that clear, everyone? Tell me. Is that clear, everyone? Tell me, guys. Now, so now we will study one by one each steps, but before that, tell me, so far is it clear to everyone? Okay, clear to everyone? Now, step 1 is identify contract. Identify contract. So it says that contract exists if all of the following, see, all of the following conditions are met. Now what are the conditions? Let's hide it off. Now you have to answer in one message only. All of you will who is this guy, yaar? What's your name, buddy? Mr. Friend of C. Vishal Jain, what's your name? Okay, fine. Others, please tell me the 5 conditions for satisfying the contract. In one message only, you will tell me. In one message, you will tell me. Come on, guys, back to pavilion, start back to the studies, come on, guys, tell me. All the 5 conditions of satisfying a contract in one message. Just write one word for each of them. My question is, I told here that contract exists if all the 5 conditions are met. Then what are the 5 conditions? See, Nissan already answered. Right and obligations, payment terms, transactions should have commercial substance, consideration should be probable to be collected. Very good. What about others? It should be approved by both the parties. Rights and obligations of each party can be identified. Payment terms can be identified. Transaction has a commercial substance, and the probable that the consideration will be collected. Okay, so these are the 5 conditions. These are the 5 conditions which needs to be satisfied. Once all these conditions is satisfied, then I can say that it is a contract exists. Contract exists. Okay, contract exists. Now, can I move on to step number 2? Now, what is the meaning of commercial substance? Not an exchange of similar items in the similar line of business. Okay, not an exchange of similar items between entities in the similar line of business. Okay, it got hidden. We can write between entities in similar line of business. Approved, rights, obligations, payment terms, commercial substance, payment to probable to be collected. Very good, Monica. Very good, Monica. Now, moving on to step number 2. Identify performance obligations. Now, how will you identify performance obligations? So, standard says that performance obligations are distinct goods or services. Performance obligations are distinct goods or services. Now, what is the meaning of distinct goods or services? Meaning thereby the goods are distinct on its own, and distinct in relation to other promises in the contract. Okay, meaning thereby entity sells it separately, customer wants to purchase it separately. Okay, entity sells it separately and customer want to purchase it separately. If both the conditions are satisfied, then I can say that the goods and services are distinct and it is a separate performance obligation. Okay, now example, see this example. An entity has entered into a contract with a customer to build a water purification plant. Okay, the entity is responsible for a project management, engineering, design, site preparation, and physical construction and integration of all the components. Now, tell me what the customer wants. What does the customer want? Customer want water purification plant. Now, if you just do the architectural design of the purification plant and give it to the customer, will the customer accept that? No. If you just construct it and give it to the customer, will the customer accept it? No, right? Customer will accept the water purification plant only if project management, engineering, design, site preparation, physical construction and integration of all the components is done and delivered to the customer. It is then only the customer will accept it, otherwise no, right? So hence it is said that even though the entity sells all these separately, but the customer doesn't want it separately, customer wants it as one. So hence it is called as a separate performance. All these will be a part of one performance obligation. Is it clear, everyone? Tell me, guys. Is it clear, everyone? Right now, standard says that if in a contract, there is single promise. There is a single promise. There is only one promise. Like in our case, right? I have only one promise to you guys that I will teach you FR. Right now, it is called a single performance obligation. But if in a contract there are multiple promises. Then let's suppose there are four promises. Okay. Now, when you purchase a laptop, you have a promise to give you the laptop. I give you the promise to give you adapter. I give you a promise to give you, you can say, a laptop bag. I give you a promise to give you an inbuilt warranty. I am giving you four promises. Right? Now, identify the distinct promises. Now, these four promises are not distinct, right? Neither the entity is selling these four separately, nor the customer wants it separately. So, what I will do, I will make a bundle of these promises. Right? Now, identify each distinct promise is a performance obligation. But in this case, there is no distinct promises, and all of them are linked to each other, right? Hence, I will bundle them, right? If not distinct, then make a bundle of the promise till the time it becomes distinct. See, I made a bundle, and now this bundle is a distinct good. This bundle is a distinct good. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me, guys. Come on. So now we have completed two steps. I have moved to step number 3. And this step number 3 is the step from where the questions come in the exam. Step number 5 is the step from where the questions come in the exam. Though the examiner can ask you questions from anywhere, but based on my analysis from the past papers or the practice kit and the revision kit and the exam kit, I have seen that the examiner majorly asks the questions from 3 areas. Step number 3, transaction price. Step number 5, recognition of revenue and special business models. So examiner asks the questions from these 3 areas majorly. Okay. So this area again is a very important area. Okay. So please listen to me carefully. But now tell me, is it clear till step number 2 for everyone? Is it clear till step number 2 for everyone? Wonderful. Step number 3. Step number 3 is transaction price. What is the meaning of transaction price? Transaction price means consideration that an entity expects to be entitled from the customer. Okay. What is the amount that the entity expects to receive from the customer? Okay. What is the amount that the entity expects to receive from the customer? It excludes the amount paid to the third parties. Now let's suppose. Let's suppose Reliance. Let's suppose Reliance sold some goods to A, and the value of the goods was 100. Right now, coming to discussing in relevance to the Indian scenario. Okay, the term might change according to the country to country. Now let's suppose in India we have GST, right? Some other countries might have VAT, right? Now GST. Let's suppose India, it applies GST at the rate of 18%. right? So it is 18. Now the invoice amount is 118. Now tell me how much is the transaction price for Reliance? 118 or 100? Tell me what is the transaction price for Reliance? See, I expect 118 from my customer. I expect 118 from my customer. So ideally, if you read this line, what is the amount that the entity expects to be entitled from the customer? It is 118, right? But now if you read this line, it excludes the amount paid to third parties. Now in that case, you have to take 118 minus 18 is equals to 100 is your transaction price. 100 is your transaction price. So transaction price should be 100 excluding GST. Amount payable to third parties means you can say government, basically government. Right, now here in the transaction price, you have to study these 4 adjustments. In transaction price, you have to study these 4 adjustments: variable consideration, significant financing component, non-cash consideration, and consideration payable to customer. Consideration payable to customer. Okay, so these are the 4 points: variable consideration, significant financing component, non-cash consideration, and consideration payable to the customer. Now we'll discuss with the help of sufficient number of examples. Okay, now what is the meaning of variable consideration? What is the meaning of variable consideration? I give a few examples like real estate. DLF have entered into a contract. DLF has entered into a contract with let's suppose Fortis to construct a hospital. Okay, with Fortis to construct a hospital. Now Fortis mentions that DLF is the entity in my case and Fortis is the customer. Okay, because DLF is the real estate contractor. Now developer. Now let's suppose DLF has entered into contract with Fortis for construction of a hospital, and the Fortis says that if you construct this hospital within 2 years, I will give you $1 million as the $1 million. I will give you $1 million. Okay, this is a transaction price. But now the Fortis is putting some conditions here. If you give me early delivery, I will give you a award of I will give you award of 1000 let's suppose 0.5 million. I will give you an award of 0.5 million. Now if you give me early delivery by 6 months, I will give you award of this amount. If you give me delayed delivery, then I will charge you a penalty of this amount. Now what happens? There are multiple scenarios, right? If you give the delivery within 1 year, you will be the contract price becomes 1.5 million. If you give the delivery by you can say 1.5 years, the contract price becomes you can say 1.3 million. If you give the delivery on second year end, then the contract price is 1 million. Right? Now if you give the delivery beyond 2 years, then the contract price is 0.8 million. Right? So the transaction price changes. So this is called as variable transaction price, variable consideration. Now the standard the question here is will we include this variable consideration as part of the transaction price? Will we include this variable consideration as part of the transaction price? The standard says yes, but the standard puts a condition along with that. The standard says that yes, you can include variable consideration as part of your transaction price, provided condition here, the condition, read the condition. Yes, but only to the extent it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated is subsequently resolved. Okay, meaning thereby based on current estimates, based on current assumptions, you are certain that you will not reverse this revenue in the future. Based on current estimates, based on current assumptions, you are certain that you will not reverse that in the future. In the future, the estimates might change and you might be required to reverse it off. That is possible. But based on current estimates, you will not reverse. Okay, you are certain that we will not be required to reverse in the future. That's what it says. Okay, it says that yes, you can recognize. Okay, yes, you can recognize. Is it clear, everyone? The meaning of variable consideration, and will it be included in the transaction price or not? Tell me, guys. If the answer to question number 1 is yes, that we will include the variable consideration as part of the transaction price, then at what amount? Then at what amount? The standard says that there are two methods. There are two methods: expected value method and the most likely method. Expected value method and the most likely method. What is the meaning of expected value method? Expected value method means let's suppose this is how I will take it, explain it off. Okay, now expected value method. This method is to be used when there is a range of possible outcomes. Now there are multiple outcomes. Now you can get 1.5 million as a transaction price, you can get 1.3 million as transaction price, you can get 1 million as transaction price, and you can get 0.8 million as transaction price, right? The probability attached here is 60 not 60, let's suppose 40%, 25%, 15%, and 20%, right? Now what is the expected value? Expected value is 1.5 into 0.4 is 0.6. Okay, 1.3 into 0.25 is 0.3, 0.15 and 0.16. Total is how much? 0.6 plus 0.3 plus 0.15 plus 0.16 is equals to 1.21. This is your transaction price in that case. This is your transaction price in that case. Is that clear, everyone? Tell me. Is that clear, everyone? Tell me, guys. Come on. Wonderful. Now, what is the meaning of most likely method? What is the meaning of most likely method? Means you have only two possible outcomes. Okay, it has to be used when you have only two possible outcomes. In we discussed about, we took an example of quality bonus, right? We took the example of quality bonus. Either you will get it yes, or you will not get it. If there is a high probability that yes you will get it off, then yes, this is the amount to be included in transaction price. Okay, when there are two possible outcomes. See here, sum of probability weighted amounts and single most likely amount. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me. Whenever I wait for you guys to respond, I always think of one song. Whenever I am waiting for you guys to respond, in my mind, one song always, it's like on loop always. Can you guess that song? Can you guess that song, anyone? Tell me, guys, come on. Some fun time. In my mind, a song comes on loop, runs on loop. Bol do na zara. Yes, it's in Hindi. Yes, the song which you have recommended is quite good one. I think I can consider that one. इंतहा हो गई इंतजार की, right? Okay, back to studies. Back to studies. Fun time over. Back to studies. Now, significant financing component. Okay. Rather than going to the concept, let's come to the example. What happens? Transaction price is $. Okay, Okay, contracted. Now, this is point number A, this is point number B, this is point number C. Tell me, at what point do you think I will recognize revenue? At what point do you think I will recognize revenue? At what point do you think I will recognize revenue? Tell me, guys, at what point do you think I will recognize revenue? A, B, or C? Guys, it was just for a refresher. Okay, it was just to lighten up the mood. So please come back to the studies. Okay, A. Someone is saying A. Any different answers? All of you are saying A. Hers is saying C. Hers. And the very first moment when I was discussing revenue today, I told what? When will I recognize revenue? When I have transferred the goods. Consideration received or not doesn't matter to me. If I have transferred the goods, I am eligible to recognize the revenue for that. I am eligible to recognize the revenue for that. Okay. Now, so definitely I will recognize revenue here. I will recognize revenue here. But when I am receiving the consideration, tell me, when I am receiving the consideration, I am receiving the consideration on this date. I will receive the consideration on this date. Now, but I have to recognize the revenue here. So what will I have to do? What will I have to do? Tell me. I have to determine, I have to find what is the value of this consideration on this date. And what is it called as? Tell me. What is it called as? Tell me. What is the value of this consideration on this date called as? What is the value of this consideration on this date called as? What is the value of this consideration on this date called as? Present value. Very good. So the present value of this consideration I will recognize as my revenue. I will recognize as my revenue. So how will the journal entry look like? Journal entry will be like this. Okay. Trade receivables account debit to revenue. Now here what will I do? Since I have recorded the present value of it, so I have to unwind the present value. How will I unwind? I will record trade receivables account debit to finance income. Right now here what I'll do? Trade receivables account debit to finance income, right? And now here what will I do? I will realize my trade receivables, that is bank account debit to trade receivables. Bank account debit to trade receivables. Is it clear, guys? Tell me. Is it clear, this one? Tell me. Why finance costs? Trade receivable is an asset. If you are unwinding the liability, it will give rise to finance cost. If you are unwinding an asset, it will give rise to finance income. Is journal entry important? Queen, understand. Might be in the exam, they might ask journal entry, they will not ask journal entry. Might be the case. I don't know. They will ask or not. Okay. Sometimes they have asked, sometimes they have not asked. But if you understand anything by way of journal entry, the understanding becomes quite very clear. This is what I assume. Okay. So when even now, whenever I stuck at any situation, I got stuck in any situation, I pass journal entry for that. Whenever I pass journal entry, things become quite very clear. Okay, so journal entry that way is important, and in the exam also journal entries have been asked in the past. Okay, it has been asked. So you have to study journal entries. Now similarly, now different case, this is point number A, point number B, point number C. Contracted consideration again is contracted consideration is $100,000. Okay, market rate of interest, consideration received, consideration transferred, contracted consideration is this much, and market rate of interest is 10%. Now tell me, where do you think I will recognize revenue? Where do you think I will recognize revenue? Tell me. Where do you think I will recognize revenue? A, B or C? Which date? Which date do you think I will recognize revenue? C. Very good. So I will recognize a revenue here, but I have received the consideration here, right? Even if I receive the consideration here, will I recognize it as a revenue? No, it is called as advance. It is called advance. Now tell me, consideration is received here, but I will recognize revenue. So I will have to find the value of this consideration on this date. What is it called as? Tell me, what is the value of the consideration of what is the value of the consideration on this date called as? What is the value of the consideration on this date called as? Value of the consideration on this date is called as what? Future value. So what is journal entry? Journal entry will look like this: bank account debit to contract liability, right? Now here what will happen? Finance costs account debit to contract liability, right? Finance costs account debit to contract liability, right? Contract liability account debit to revenue. Is it clear, everyone? Tell me, guys. Yes, bank account debit to advance, or you can say contract liability. I prefer to write contract liability. Is it clear, everyone? Coming back to the concept, significant financing component. What is the meaning of significant financing component? Means when either party provides a benefit of financing to the other party. Okay, when either of the parties provides a benefit of financing. Now in case A, tell me who provided the benefit of financing to whom? Tell me. The entity provided the benefit of financing to the customer. In case A, entity transferred the goods but provided a benefit of financing to the customer. In case B, customer paid in advance, right? So customer provided the benefit of financing to the entity. But in both the cases, who is passing the journal entries? In whose books we are discussing? Tell me. We are discussing in the books of the entity. Now Krishna is asking what amount will be taken to contract liability. The whole amount that I have received here, 100,000 will be recorded here, right? Finance cost at 10% is 10,000 here. It is 11,000 here. 11,000 here. How come 11,000? See, 100,000 is the bank amount of what I have received. 10% on that is finance cost 10,000. Now the contract liability becomes how much? 110,000, right? So 10% on this becomes 11,000, right? I record finance cost at the rate of 11,000. And how much? 121,000 I will record as revenue. Is that clear, everyone? Now, so when either party provides a benefit of financing to the other party, it is called as a financing component exists. Right now, when a financing component exists, what you have to do is recognize revenue, that value of the contractual consideration on the date when the control of the goods or services are transferred to the customer. Okay. Now, many students have this wrong notion in the mind that in the case of significant financing component, we recognize the revenue at the present value. No, my friend, no. It is not about present value. It is about the value of the consideration that you have received. What is the value on the date when you are transferring the control? What is the value on the date when you are transferring the control? It might be the case that you will receive the consideration after a few years, or it might be the case that you have already received the consideration in advance in the prior itself. Okay, it can be any case. So let's not mug up the concepts, rather understand the logic behind that. Is it clear, everyone? Is it clear, everyone? Now, non-cash consideration. Entity will transfer the goods. Entity transferred the goods, and now customer will pay. Let's suppose entity transferred laptop. Okay, the market price of the laptop was $7,000. Okay, but customer has paid only $6,500. Tell me how much revenue should I recognize? How much revenue will the entity recognize? Tell me. How much revenue will the entity recognize? Tell me. How much revenue will the entity recognize? Tell me, guys. Come on. Dakshesh, Salman, my dear friends, understand, it doesn't matter that what is the price of that asset, what is the price of the goods that you are selling. What matters is what you have received. What matters is what you have received. Okay, Dakshesh and Salman. Is it clear, Dakshesh and Salman? It doesn't matter what is the list price of the asset. Okay, of the goods that you are selling. What matters is I'm not talking about asset received, Nishan. I'm not talking about asset received. I'm talking about if you have received cash. If you have received what cash. Okay. Now it doesn't matter what you have. It doesn't matter what is the list price. What matters is what you have received. What matters is what you have received. Okay. Now, similarly, if in the place of cash, let's suppose you have received the consideration in the form of non-cash. Okay, and the fair value of the non-cash goods is $6,300. Tell me, in this case, now what will be my revenue? Now what will be my revenue? Tell me now. Now what should be my revenue? Right. So standard says that fair value of goods received. Fair value of the goods received. Okay. Fair value of the non-cash consideration right here received. But if in any situation you are unable to find the fair value of this consideration, then in that case you can take the fair value of the transferred goods or services. Then in that case, so first priority is 6,300, but if you are unable to find the value of the 6,300, then you can take 7,000 as revenue. Is that clear, everyone? Now, consideration payable to the customer. Now, when you purchase the goods from Amazon, or let's suppose Paytm, when you book flight tickets from Paytm, or when you book flight tickets from Make My Trip, or any platform, have you ever got a cashback? Have you ever got a cashback? Tell me, have you ever got a cashback? Ever got a cashback? Cashback. Right? Now, let's suppose Indigo. I booked a flight ticket, and in Indian rupees I gave him rupees 6,000. In Indian INR I gave him 6,000. Now once I booked the ticket, I got a cashback of rupees 500. Tell me, what is the cost of my flight tickets? The cost for me is 5,500. Now what is the revenue for Indigo? What is the revenue for Indigo? What is the revenue for Indigo? Tell me what is the revenue for Indigo? It is 5,500. It is 5,500, right? So that's what it says. If the consideration is payable to the customer, okay, then reduce the consideration from the transaction price. Clear, everyone? Is it clear, everyone? Once I received a cashback on Google Pay for a transaction I did for, I remember I did the transaction of rupees 1,000 and I got a cashback of 700. But that was, I think, 3 to 4 years back. That was something like a big moment for me. Yes, I have got it. Step number 4. Step number 4. Allocate transaction price to each of the performance obligation. Okay. Allocate transaction price to each performance obligation. Now you remember in the very first instance when we were discussing revenue today, okay, we discussed that the transaction price has to be allocated to each of the performance obligation. Now so far we studied 3 steps. And now what were the steps? The 3 steps that we studied. First of all, we identified if a contract exists or not. Okay. Then we discussed in the contract how many performance obligations are there. So let's suppose there are 3 performance obligations in the contract. There are 3 performance obligations. Now after that I identified for this entire 3 performance obligation, what is the transaction price which I am charging for the entire 3 performance obligation? What is the transaction price that I am charging? Okay, this transaction price is a blanket, is like a blanket for the entire 3 performance obligation. It's like a blanket, right? Now I have to break this blanket now. Okay, and I have to find specifically for this one. Now, when you have to find specifically, now I have to break this blanket. I have to find specifically for each of the performance obligation. Now, how will I do that? Now, in that case, what will I do is I will allocate the transaction price. To each of the performance obligations, in the ratio of the standalone selling price of each these performance obligation. Okay, it says that allocate the transaction price to each performance obligation in the ratio of the standalone selling price of each performance obligation. Right now the question is saying, now there is another question coming up. What if standalone selling price is not available? Then the standard says that in that case you can take adjusted market assessment approach. Let's suppose for a particular goods the standalone selling price is not available. Then what will I do? I will just see in the markets if similar goods are sold, then what is the price of that and what are the different features. So I will adjust the market price and I will find it off. Okay. Now, if no one in the market sells that goods, then I will find what is the cost to manufacture this good. Okay. And what is my general profit margin? Okay. What is general profit margin? So then this is now third is residual. Third is called as residual. Okay. Now the standard says that you have to allocate in this ratio. Okay. Now let's suppose. So basically, let's suppose there are 3 performance obligation. Number 1, obligation number 2, obligation number 3. For performance obligation number 1, standalone selling price was available. For performance obligation number 2, standalone selling price was not available, but adjusted market price was available. Now for performance obligation number 3, standalone selling price not available, adjusted market price not available, but yes, you know the cost plus you know the margin. Now this is the ratio over which you will have to allocate the transaction price to each of the performance obligation. Is that clear, everyone? Now if you can recall, we discussed in our regular classes an example on cost plus margin. Like question was newborn company. new margin or new market company, something like this. There was a question, right? I have that question. I kept that question as an important question list. Just give me a minute. I do have that question. See, new market company. Yeah, this is the question. Okay, where you have to apply cost plus margin approach. It was not 227, it was around 87 or 77, something in that range it was there. Okay, allocation of discount, it is not applicable for you guys. Please strike it off. It is not applicable for you guys. Now, recognize revenue as and when the performance obligation gets satisfied. Tell me guys, we discussed step number 1, 2, 3 and 4. We discussed step number 1, 2, 3 and 4. Is that clear to everyone? We are moving on to the last step. We are moving on to the last step of revenue recognition. Is that clear everyone till here? Now, step number 5 is when do we recognize revenue? So when the performance obligation is satisfied. When do we recognize revenue? When the performance obligation is satisfied. Now, when okay, fine. Now, when we will identify that the performance obligation gets satisfied in the cases when the control of the goods or services are transferred to a customer. Okay, when the control of the goods or services are transferred to the customer. Okay, so when the control of the goods or services are transferred, it is then we understand that the performance obligation gets satisfied. And then we have to recognize the revenue. But the question that comes up here is how to identify if the control is transferred or not. Okay, how to identify if the control is transferred or not. Okay, how to identify if the control is transferred or not. See, so what I'm trying to say here is as per IFRS 15, it says that recognize revenue when the control gets transferred. Recognize revenue when the performance obligation gets satisfied. Now, performance obligation gets satisfied. When does the performance obligation get satisfied? When the control gets transferred. Now, the question that comes up here is how will we identify if the control has got transferred or not? So for that, we need to understand the meaning of control. Okay, so standard says that meaning of control is ability to direct the use plus ability to prevent others from directing the use. If this is the pencil, I just need to understand this control is mine or not. Now this pencil is mine. Okay, now I have to assess this. Who controls this pencil? Tell me how I use this pencil. Can anyone tell me? Can anyone tell me, or can anyone restrict me how I use this pencil? Now, now I am using this pencil to take up classes. Next time when I am watching a movie, I might use this pencil for surfing. Okay, so I might use this pencil in any manner I want to. No one can restrict me. But now let's suppose my friend visited me. Okay, now he asked me this pencil. I gave him. Right? But now let's suppose I don't want to give him. Do I have the right to say no? Tell me, do I have a right to say no? Yes, I do have a right to say no. Giving him or not giving him is my decision. I have the right to say no, right? So I have the ability it doesn't say that you have to say no. No, it doesn't say like that. It just says that you have the ability to say no. You have the ability to say no. Okay, yes, I do have the ability. Okay, then obtain substantially all the economic benefit. Now, whatever is the benefit that comes from this pencil is all mine, are all mine. What are the indicators of transfer of control? It says right to receive consideration. The right to receive consideration gets established. The customer has the legal title of the asset. Okay, customer has the legal title. Transfer of physical possession, risk and rewards gets transferred. Customer has accepted the goods or services. Now, this has to be applied on case to case basis. This has to be applied on case to case basis. Now, how does control gets transferred? Over time or at a point in time? How does control gets transferred? Over time or at a point in time? See, now we definitely by now we know that the revenue needs to be recognized when the control when the performance obligation gets satisfied. Performance obligation gets satisfied when the control gets transferred. Control gets transferred under 5 indicators we discussed, right? The 5 indicators, right? Now the control can get transferred in 2 ways: at a specific point in time or over a period of time. On a case to case basis means these indicators are you can say illustrative list. They are not the exhaustive list. They are illustrative list. Okay. So now on a specific case to case basis, you have to assess whether the control got now. There might be a situation where when the physical position is transferred, but the control is not yet transferred. There might be a case. There might be a case when the physical position is not transferred. But the control is transferred, right? So you have to assess, you have to read the contract and understand. Okay, apply this to the scenario, and on a case to case basis analyze when does the control gets transferred, or whether the control is transferred or not. Is it clear, everyone? Yes, is it clear to you now? Wonderful. Now, how does the control get transferred? So basically the control can get transferred at a specific point in time or over a period of time. Now, let's suppose in case of our classes, tell me, the control gets transferred at a specific point of time or over a period of time. Tell me, guys, come on. Control gets transferred at a specific point in time or over a period of time. You paid the whole fees upfrontly, right? We received the fees, right? Now, when we receive the fees, when we receive the whole of the fees, tell me, am I transferring you the whole class on the very same day? No, I am transferring over a period of 3 months, right? I am transferring over a period of 3 months or 30 classes around, right? This batch we took around 36 classes, right? This batch we took around 36 classes for, you can say around 2.5 hours to 3, on an average, you can say 3 hours each, 2 to 3 hours each. On an average, right? Now, so it says, now how will we assess whether the control gets transferred at a point in time or over a period of time? The standard says that entity transfers control. There are 3 conditions given. Standard says that if any one of the above is satisfied, when I say any one of the above, I mean to say this, just a minute. Any one of the above is satisfied. These 3, any one out of these three is satisfied, then it is over time, over a period of time. Okay. Otherwise, it is a point in time. Meaning, thereby point in time means none of the above is satisfied. None of the above is satisfied. None of the above is satisfied, right? Then we say point in time. Now I have 2 examples. Let us analyze these 2 examples in this case and then understand it off. Now, I am DLF. I construct residential apartments and I sell it off to the customers. I construct residential apartments and I sell it off to the customers. Now, so this sale of residential flats, the control gets transferred over a period of time or at a point in time. Let us analyze it off. Condition number 1 is what? customer simultaneously receives and consumes the benefit as the entity performs. Now tell me, as the DLF constructs the residential apartment, tell me, customer is getting any benefit? Customer is getting any benefit? Tell me. No, customer is not getting any benefit. Neither the customer is getting any benefit, nor the customer is consuming any benefit. Now, when the DLF constructs the apartment, entity's performance means DLF construction of apartment creates and enhances an asset that the customer controls. Tell me, when the DLF is constructing the apartment, do you think the customer controls that apartment? Do you think a customer controls that flat? Let's suppose I have booked one flat in DLF apartment. I have booked a flat in DLF apartment, okay, and paid token money. Now tell me, do you think I control that? I control that flat now? The flat which I have booked, do you think I control? No, I don't control. Why I don't control? Because the whole control lies with DLF now, okay, and I might cancel the contract at any given point of time. And when I cancel the contract now, okay, when you want to think you have control or not, think of it this way. If I cancel the contract now, let's suppose if I cancel the contract now, okay, I booked the contract and paid a token money of, let's suppose, 2%. I paid token money of 2%. Now after 1 year of booking the contract, I am not interested in that property. I want to cancel the contract, and the property is constructed to the extent of 40%. Tell me, when I will cancel the contract, will I be required to pay the remaining 38%? No. Only the 2% which I have paid will be forfeited. I am not required to pay anything extra. Yes or no? Why? Because I don't control the flat. Right? So what happens? Entity's performance creates and enhances an asset. Yes. That the customer controls? No. So this condition also fails. Entities does not have any alternative use of the asset. Now tell me, when the flats are getting constructed, don't you think the DLF can use it for any purpose, like for example warehouse, right? They can use it. So this condition also fails, right? So sale of flat, condition number 1 fails, condition number 2 fails, condition number 3 fails, and hence it is point in time. Meaning thereby, when the flats are handed over to the customer, it is then the revenue has to be recognized. The entire revenue at that point of time has to be recognized. Is it clear, everyone? Tell me. Now, construction of building. Now, I had a land, okay, now on which I want to construct, to construct a duplex. On that land, okay. Now, so I thought of appointing DLF to construct a duplex on that land. Now, a duplex constructed a portion of it. Now, okay, now let us analyze these three conditions. Customer simultaneously receives and consumes the benefit as the entity performs. Now tell me, as and when the DLF is constructing that property, then in that case, am I getting any benefit? No, I am not getting any benefit. Condition number 1 fails. Now, Riddhi, it will take me half an hour more to complete this standard, and then we'll wrap up the class. Okay, 20-25 minutes max to max. Okay, 20 to 25 minutes. Now, again, entity's performance creates and enhances an asset. The DLF is constructing the duplex. Okay, that the customer controls. Yes, because the land is mine. And anything which gets constructed over that land is also mine. Right? So I control that. So condition number 2 passes. Now condition number 2 passes. Any one passes over time, right? So over a period of time, right? So this is what is it called as over a period of time. Now, question number 3. See, in step number 5, which was recognize revenue as and when the performance obligation gets satisfied, right? Now, what is the meaning of this point? So in this, first of all, point of the performance obligation gets satisfied means what? Control gets transferred. I explained the meaning, right? Now The control can get transferred in two ways. The control can get transferred in two ways, at a point in time or over a period of time. At a point in time or over a period of time, right? That I have to analyze based on these three conditions. So these are the 2 points which we discussed so far. Now the third point, if the performance obligation or the control gets transferred at over a period of time, if the control gets transferred over a period of time, how will I recognize revenue? How will I recognize revenue? So in that case, standard says that you have to recognize revenue also over a period of time. Now, if you have to recognize revenue over a period of time, on what basis? On what basis? Let's suppose now I have transferred a percentage of the control of the asset. How much revenue shall I recognize now? Okay, so standard says that to measure that progress, there are two methods, input method and output method, right? What is the meaning of input method? Input method means efforts of the entity, and output method means value to the customer. Value to the customer. Efforts of the entity means, let's suppose my classes, like I know that total class I have to take is 37. Okay, I have taken up 20 classes. So what is the effort that I have taken? What is the percent measure progress? 20 by 37, right? But now output method is means value to the customer. Though I have taken 20 classes, but in that class 20 classes, I know that the question in the exam will come only for 30 marks. Okay, so what is the percentage of completion? 30%. Okay, 20 by 37. So I have completed 30% only. I have completed 30% only, right? So this is how I have to measure the progress, input method and output method. The best way to identify the input method is the cost incurred versus total estimated cost. The best way for output method is work certified. Is it clear, everyone? Is it clear, everyone? So this completes our 5 steps. Now we have to discuss five specific business models. Pranav, let me cover this and then I'll take up, because what you are asking is from financial instruments. I am now in revenue. Tell me how to manage this. So first of all, let me complete this one. Specific business models, principal versus agent. Now what happens, when you book the tickets from the Make My Trip, and Make My Trip, the ultimate is Indigo, Make My Trip is agent, and you are the ultimate customer. Now tell me, who should recognize what revenue? So standard says that the agent is providing services of just creating a marketplace wherein the seller and the buyer can come in. Okay, so he is providing just the aggregator services, so he should recognize only commission income. So since the Make My Trip is an agent, he should recognize net revenue. He should recognize net revenue. Okay, and Indigo is the principal, and hence he should recognize gross revenue. So what is how they will recognize revenue? So Indigo will recognize the revenue of 6,000 and record a commission expense of 500. Make My Trip will record a revenue of 500. So this is how they will recognize revenue. So principal recognizes gross revenue and agent recognizes net revenue. Now the question that comes up here is how to identify who is the principal and who is agent based on these 3 indicators. Tell me, in our case, who has the primary responsibility of fulfilling the contract? Right, customer. Let's suppose I have booked a flight. Tell me, who will give me the transport services? Make My Trip or Indigo? Indigo. Who bears the inventory risk? Let's suppose there are 180 seats in a flight, okay, and Make My Trip is able to sell only 50 seats. 130 seats are remaining vacant. Tell me, who will bear the inventory risk? Indigo. Who sets the price? Indigo. Now you will say that, sir, different websites have different prices. Now if you see, the base price will remain the same in every website. It's just the discount and the offer that differs. It's just the discount and the offer that differs. Okay, so base price remains the same in every website. Okay, so this is what. So in that case, this is how. So primary, who has the primary responsibility of fulfilling the contract, inventory risk, and price establishment. Okay, based on that, I will analyze who is the principal and who is the agent. Okay. Now, sales with a right to return, I will discuss. First of all, I am going down warranties. Warranty. Understand, guys? For warranties. So I discussed initially also today. Sorry, my bad. Warranties are of two types. Inbuilt warranty and extended warranty. Now tell me, inbuilt warranty, is it a separate performance obligation? No. Extended warranty, is it a separate performance obligation? Yes, right? So standard says that the warranty are of two types. Warranty that are a part of the product, that is not a distinct good or services, not a separate performance obligation. Warranties that are distinct good or services, that is option to purchase separately is there. Okay, separate performance obligation, right? Now if it is separate performance obligation, you will recognize revenue over the warranty period. Now if warranty are a part of the product, that is not a distinct good or services, not a separate performance obligation, we have to recognize provision on that as per IAS 37. Do you remember in provisions standard we discussed about warranty provision for warranty expense? Do you remember that? Tell me, guys. Do you remember that? So we have to create provision as per IAS 37. Contingent arrangement, consignment arrangement. Now consignment arrangement, what happens? Consigner, there are three parties: consigner, consignee, and end customer. Now consigner just gives the goods to consignee, who sells it to the end customer. So consignee acts as the agent of consigner. Tell me, at what date control is transferred? This is point number A. This is point number B. Tell me, when is the control transferred? When is the control transferred by consigner? A or B? When is the control transferred in this case? Tell me. Control is transferred on B. Okay, B. So revenue is recognized when the control gets transferred, that is point B. Control is transferred when the consignee sells the goods to the end customer. Now tell me, consignee will recognize what? Net revenue. Consignee will recognize what? Net. Consignor will recognize what? Gross. Is it clear, everyone? Now, bill and hold arrangements. Now, the classic example of bill and hold arrangement is in shopping mall, we purchase the clothes from one particular outlet and then keep it there itself and then go to another outlet for doing the shopping, because we don't want to carry the load everywhere, right? So this is called as bill and hold. So basically we purchase the goods but keep it there and go to the other shops, right? For the convenience of the customer. Now the standard says that if all of the following conditions are satisfied, then bill and hold arrangement is a separate performance obligation. Now understand. Let's suppose this is me, VJ, and this is let's suppose a shopping mall. This is a shopping mall. Okay, I went inside the shopping mall, I purchased the clothes, but I kept it here. I kept it there. Okay, it said, okay, I paid the amount and I kept it there, okay, which I will collect after some time. Now tell me, the shopping mall is giving me what? Two things. What? One is the clothes and another is what? Warehousing services. Warehousing services is giving me two things, clothes and warehousing services. So standard is saying that if all the four conditions get satisfied, then this warehousing services is a separate performance obligation. And the amount which I have paid to the mall will need to be allocated between these two. Okay. Now, at FR level, you will just need to identify if bill and hold is there or not. Okay, if bill and hold is there or not. I have not seen even a single question wherein you have to find out the value of the warehousing services. Okay, so you just need to find out if bill and hold exist or not in this case. So how will you do that? You have to just see whether the 4 conditions are satisfied or not. How will you see that? Customer has requested the arrangement. Customer, I requested please give me warehousing services. Product must be identified separately as belonging to the customer. Product is ready for the transfer. Entity can neither sell or nor use the product. If all the conditions get satisfied, then it is separate performance obligation, allocate transaction price and recognize revenue. Allocate transaction price and recognize revenue. Is it clear, everyone? Tell me. Basically, these are done by manufacturers who have lack of space. These services are taken by the manufacturers who have some lack of space. So what they want to do is when they purchase the goods, but they keep it with the supplier itself. Okay, they keep it with the supplier itself, and as and when it is needed, they transport it to their premises. Repurchase agreements. Now the repurchase agreement, you have to entity sold the goods and received here. Entity sold the goods and received the $100 transaction price. Now standard is saying if this repurchase contract can be of 2 types. Entity has an option to repurchase the asset. Now this repurchase can be of 2 types. What are 2 types? Repurchase price is greater than the original selling price, 100, and the customer cannot use the goods or services. Meaning thereby, I have sold the goods to the customer, but this customer will not be able to use the goods, but I will repurchase at a later date and I will pay you 110. And I will take back the goods. So now tell me, is the customer getting any benefit? No. Customer is not getting any benefit because the customer cannot use the goods. So is it about the goods? No. Now see, understand the contract. When I sold, I received 100. I means entity. When I sold, I received 100. When I am repurchasing, I will be paying 110 to repurchase. Right? I will paying 110 to repurchase. Meaning thereby, customer cannot use the goods. Customer has got $10. Customer has got $10 because see, customer paid 100, but customer got 110. Right? Entity got what? Entity got funds for a specified period. Right? So it is what? It is called as a financing arrangement under IFRS 9. Now second, repurchase price is 80 and original selling price is 100. Means customer had to pay 20. Customer had to pay 20, but customer has got the right to use of the goods services also. Customer has got the right to use the goods. Means what? It is a lease transaction under IFRS 16. Is it clear, everyone? It is a lease transaction under IFRS 16. Coming to the contract costs. Now, the contract costs can be of 2 types. If the costs are incurred to acquire the contract, then the cost incurred to obtain a contract would not be incurred if meaning thereby these costs are incremental in nature. If these costs are incremental in nature, like for example, brokerage I told, right? Yes or no. If it is brokerage, then yes, recognize an asset and amortize over the contract term. If it is not in the nature of brokerage, transfer it to P&L upfrontly. Guys, it's not about important or less important. Pranav. Everything is important. Anything can come in the exam. Okay. Now, contract fulfillment cost. Now, to fulfill the contract, if I have incurred some costs, and now the standard says that if it is covered under respective standard, any other standard covers that, then yes, account under that standard. If no, then recognize as an asset. And amortize over the contract term. So basically, costs can be of 2 types. Cost to acquire the contract. Now, standard says that if you have incurred some cost to acquire the contract, then you have to see, is it incremental in nature? Yes. Then recognize as an asset and amortize over the contract term. If it is not incremental, transfer it to P&L. If you have incurred some cost to fulfill the contract, then see if it is covered under any other standard. Yes, then cover under that standard. If not, then recognize it as an asset and amortize over the contract term. Okay, Krishna has a query that explain the lease part. Okay, fine. Lease part. Let's suppose this is entity, sold the goods, sold the asset, and received $100. Received $100. Okay. Now later on, entity will get the goods asset back, and it will pay 80. It will pay 80. That is, say repurchase price is less than the original selling price. Right now, what entity got? Tell me what entity got. Entity got 20 extra. Entity got 20. What customer got? What customer got? Customer got the right to use for that specified period. Right to use the asset. Right, and hence it is called as a lease transaction. And hence it is called as a lease transaction. Contract fulfillment cost can be anything. Let's suppose there is a catering services, right? In the functions we do appoint some event managers, right? The event managers have incurred some cost to do the decorations and all these things, right? Those are the costs incurred to fulfill the. Those are the costs incurred to fulfill the contract. That is called contract fulfillment costs. Right now, tips from the examining team. In questions where the control is transferred at a specific point over a period of time, and the question asks you to compute revenue and cost of sales for a particular period, then guys, this is a very important point, and I have seen students making mistake here. If the overall, see, first of all, whenever the question asks you to compute revenue, cost of sales for a contract where the control is getting transferred over a period of time, first step that you will apply is you will see whether the contract is profitable contract or a loss making contract. You will first see whether the contract is a profitable contract or a loss making contract. If the contract is a profitable contract, you have to recognize a revenue and cost of sales according to the measure of progress. You have to recognize revenue and cost of sales according to the measure of progress. No challenge in that. If the contract is in loss, if the overall contract is in loss, then first of all recognize revenue and cost of sales as usual, as per the measure of progress, as usual. Then additionally, what you have to do, calculate the amount of future losses and recognize it as a provision for such losses, and add that to the cost of sales. Okay, what is the amount of future losses? What is the amount of future losses? Krishna, I explained it. No, see here, I told na repurchase price is less than the selling price. 80 I wrote here, see. Okay, so it says that what is the amount of future losses, recognize that, and recognize that for a provision for that, and add it to the cost of sales. So the journal entry for this will be cost of sales account debit to provision for loss, to provision for loss or provision for onerous contract, to provision for loss or provision for onerous contract. Okay, now I have given up an example, a question also for on this one. In the important question list, I have given up a question also in this one. So this is the question. This is the question. You want to solve this question? Let us solve this question. I think it will give you better clarity over the concept. Okay. CNN started a 3-year contract to build a new university campus on 1st April 2004. The contract for the fixed price is now. So contract price is how much? 90. Now will satisfy performance obligation. Now total cost is how much? 77 is the cost incurred, 33 is will be incurred. 77 plus 33 is what? 110. So it is a loss making contract. It is a loss making contract. It is a loss making contract. Now CNN measures the progress using work completed compared to the contract price. Okay, work completed compared to the contract price. At 31st March, a surveyor valued the work completed 63 million. Now, so what is the revenue? Revenue is 63 million. So what is the measure of progress? 63 by 90 is equals to 70%. So what should be your cost of sales? So what should be your cost of sales? 110 multiplied by 70% is equals to 77. Is equals to 77, right? Now, so what is the loss that is there? 77 minus 63. The loss that you are booking is 14. The loss that you are booking is 14. And what is the total loss? What is the total loss? 110 minus 90 is 20. Total loss is 20. So far till date you have already booked a loss of 14. So what is the loss that is not booked? 6. So you will add 6 here, you will add 6 here, you will add 6 here. Okay, you will add 6 here, so it will be 83. So the cost of sales is 83, revenue is 63. Is it clear, everyone? Now further coming back to this one, so we have done one topic is remaining. Just hold on a minute, just hold on a minute. Right to return is a very important concept, I will say. Okay, though everything is important, but what I have done is I have summarized this topic with the help of an example. Okay, with the help of an example, and made up a video for that. So I will request you to watch that video for this detailed video. I will paste the link of this video in the description box, but I will explain in a brief, concise manner here. I will explain this in a brief manner. Okay, for those who know and just want to revise, I will just explain it off in 2-3 minutes. Just give me, I will further take 2-3 minutes, not more than that, not more than that. Okay, now let's suppose what happens. Amazon sells 100 laptops to the customers with a right to return policy, Now let's suppose these sales 31st December is my year end, and I have sold these goods on, let's suppose, on 26th of December, and it can be returned within 30 days. It can be returned within 30 days. Let's suppose here 25th of January. It can be returned here. Now the question here is, can I recognize the whole amount as a revenue here? Can I recognize the whole amount as a revenue here? The answer is no. Why? Basically because few goods can be returned back. Right? Now, if few goods can be returned back, then in that case, what you will do, you will estimate what is the percentage of your returns. What is the percentage of your returns? Now, crux. Recognize revenue to the extent it will not be reversed. Do not recognize revenue for expected returns. Any amount received will be recognized as a refund liability. Journal entry meaning, what is journal entry? Because when Amazon sells goods, it receives the amount. So bank account debit to revenue. So to the extent I am reversing the revenue, I will record what? I will record a contract liability. Now, applying matching concept, if I have not recognized revenue, I will not recognize cost of sales also for that. But understand, even though I cannot recognize cost of sales, but my inventory has reduced. So what will I pass entry? I will do to inventory. My inventory has reduced. Why? Because the inventory is with the customer. So what will I do? I will record cost of sales account debit. So I'm writing here, let's suppose bank is 100, revenue is 95, and current contract liability is 5. Right? Now, similarly, inventory will be reduced by 100, cost of sales 95, and I will write here right to return asset debit 5. Okay. Now, on 25th of January, I will see if the goods are returned back to me. What will I do? If the goods are returned back to me, I will do refund liability account debit to bank, and I will receive the inventory, meaning thereby inventory account debit to right to return asset. If the goods are not returned back to me, then what will I do? I will reverse the refund liability and I will record revenue. I will reverse the right to return asset and I will record cost of sales. Is that clear, everyone? I have explained this with the help of an example. This is the example, but I have explained this in detail with the journal entries, with the amounts, everything I have done it. Okay. So if you need a clarity on this topic, I will paste the link of this video in the description box. Please go and watch that. Is that clear, everyone? Now, an announcement here. Okay, because I believe that students are office going. Okay, so what I will do, I need to take one more class for the revision, which I will not take in the weekday. Okay, I will take on the weekend. The next weekend which comes up is, tell me what? The next weekend which comes up is 2nd, I believe. 2nd of September. But understand. See, we have discussed all the chapters. Krishna, just a minute. We have discussed all the chapters. Okay, we have discussed non-current assets in the previous class. revenue in today, financial instruments I already gave you the video, and revenue and leases also we discussed, right? Now in the next class again I have to discuss few 3-4 standards, but for the groups, for the group accounting also I have already made a video in June 2023 which you can watch it off, okay. First point, now interpretation of financial statements, again I have conducted a session on June 23, so you can watch that, okay. All these things I will what I'll do is paste the link of these in the description box, okay. So now groups done, interpretation done, preparation of financial statements, okay. There is nothing for me to explain, okay. So I think you can manage this on your own, okay. I'm not discussing this part. Still, if you want to revise it, you can in September 2022 I have conducted a session for that, you can watch that, okay. I just want to take the session for the relevant chapters, okay. So this is what, now in the next class I will be taking up chapters like taxation, okay. I will be taking chapters like grants, okay. All these chapters I will take up in the next class, okay. Cash flow also in the September 2022 I have taken up, so you can watch that, all those things, okay. All those things you can watch it from there. Now Krishna has a query that if we take what is the if we treat a lease, then we have to calculate current liability and non-current liability and interest as well. Understand, Krishna, there is nothing separate from interest. Whatever is the interest it is there in the liability itself. Whatever is the interest, it is there in the liability itself. What is the entry we pass for the interest? Finance cost account debit to lease liability, right? So there is no separate interest. It is there in the liability itself, and you have to follow that method for classifying current and non-current, which I have discussed in the class. Yes, Harsh, in the description box I will paste the link for all the videos. Difference between coupon rate and discount rate. Coupon rate, let's suppose I have taken a loan from the bank at the rate of 10%. So the 10% is the coupon rate. Now the discount rate can be coupon rate, discount rate can be effective interest rate, discount rate can be market rate. Discount rate basically means the rate which you use to discount the cash flows to arrive at the present value. Okay. Tomorrow we don't have any class. The next revision session will happen on Saturday, okay, or whatever is the date and time I will announce it off, okay. Within this week I will announce the date and timing for the third day, okay. The discount rate means it can be anything. Discount can be coupon rate, discount rate can be effective interest rate, discount rate can be required rate, discount rate can be anything, okay. It can be market rate of interest, it can be, you can say, implicit rate, it can be anything, okay. So that's all for the day, guys. And yes, all of you, once I end this live streaming, all of you please give the feedback in the comment box, okay, in the comment box, not in this live chat, in the comment box, please give the feedback, okay. Now that's all for the day. Thank you guys, I hope you enjoyed the session. Thank you, bye bye.